Forward. This manual is an exam preparation tool for future life insurance agents registered in the Life License Qualification Program, LLQP. Its contents will help candidates develop the competency targeted in the Accident and Sickness Insurance module of the LLQP curriculum. Recommend individual and group accident and sickness insurance products adapted to the client's needs and situation. Chapter Overview page. The first page of every chapter outlines the curriculum module competency components and sub-components that will be covered, highlighting which of the evaluation objectives are addressed in each of the manual's chapters serves to identify the contents that are essential to attain these objectives. It is thus recommended that candidates regularly review the competency components and sub-components in order to contextualize and assimilate them as they read each chapter. This will help develop an understanding of the nature and scope of the evaluated competency. Candidates must have fully understood the knowledge, strategies and skills covered in each chapter in order to successfully pass the corresponding module of the LLQP licensing exam. Chapter 1. Financial protection provided by accident and sickness insurance. Competency component. Assess the client's needs and situation. Competency sub-component. Articulate the client's needs based on the risks that could affect his or her financial situation. 1. Financial protection provided by accident and sickness insurance. The insurance company's acts of the various provinces define what is considered to be accident and sickness, A&S, insurance. The provincial acts are similar in content and most will include the following when defining A&S insurance. Benefits for loss resulting from accidental bodily injury, including death, suffered by the life insured. Benefits for loss resulting from the sickness or disability of the life insured. Refund of expenses incurred due to sickness or accidental bodily injury suffered by the life insured. Refund of expenses incurred due to medical treatment of the life insured. More simply put, accident and sickness insurance relieves insured individuals of the burdens of medical expenses or income loss arising from illness, injury or necessary medical treatment not covered by the provincial health insurance plans. This chapter describes the risks that businesses, individuals and their families face, and the ensuing needs that are met by various types of A&S insurance products. The products themselves, as well as the process of recommending and implementing them, will be discussed in more detail in the chapters to come. 1.1 for individuals and their families. Although various types of accident and sickness insurance can play a critical role in protecting the financial viability and longevity of many businesses, the primary role of most A&S policies is to protect the finances of individuals and their families during times of medical or health crisis. 1.1.1 Financial goals of individuals and their families. Most families have a fairly common set of goals that require regular cash flow and a surplus that can be invested for the long term. Although the specific amounts and details will vary from family to family, the three main financial goals remain similar. Accumulate wealth, patrimony. Create a retirement income. Meet family needs. 1.1.1.1 Wealth accumulation. Once immediate needs, food, accommodation, clothing, means of travel, entertainment, etc., have been provided for from current income, any surplus should first be allocated to setting up an emergency fund, 3 to 6 months of current expenses. Excess income can then be earmarked for wealth accumulation goals, both short and long term. Wealth assets can be employed to achieve a wide variety of family goals. to be invested in a home or vacation property. Building a portfolio of securities, registered and non-registered, to provide additional current income, growth or funds to draw on in retirement. Building a legacy to pass along to the next generation or to posterity in general. 1.1.1.2 Retirement income. At some point nearly everybody retires. But retirement means different things to different people. Some want to travel, some want to sit by the lake at the cottage and enjoy nature, others want to spend their time engaging in community help projects. The list is as diverse as a people. But all types of retirement have one thing in common. They all require income in one degree or another. Retirement income can come from a variety of sources. Government pension plans, Canada, Quebec pension plans, CPP and QPP, and old age security, OAS. Employment pension plans. Private pension plans, registered retirement savings plans, RRSPs. Non-registered investments. Inheritances. Part-time employment or self-employment. Liquidation of assets. But almost all of these sources require that the retiree has worked, saved and invested for a significant number of years prior to retirement. And continuity of work can be interrupted by a number of factors, including economic downturns and disability. It is in the area of disability and the recommendation of products that can replace income during periods of disability that the life insurance agent has a significant role to play in protecting the financial welfare of individuals and their families. 1.1.1.3 Family needs. Prior to retirement and prior to, or concurrent with, investing for wealth accumulation, families need to generate income and set aside savings to meet ongoing family needs. Tuition, and room and board, for higher education for children, orthodontics, family vacations, these and more all need to be provided for long before retirement. And many families are faced with providing extra support for special needs children, dependent aging parents or, boomerang, children forced by economics or other circumstances to return to the nest. 1.1.2 Financial risks that threaten individuals and their families. Meeting the above-noted family goals is primarily dependent upon clients' ability to generate sufficient income and savings over time. Unfortunately, there are a number of risks that could disrupt those plans, such as unexpected expenses, loss of income or savings, lower standard of living, inflation, longevity, debt. 1.1.2.1 Unexpected expenses. In theory, a budget will help clients to match income and expenses and prepare for future financial eventualities. But not everyone has a budget. Not everyone who has a budget is good at making a realistic budget. And certainly many people with budgets are not good at sticking to them. But even the best budget cannot anticipate every possible expense. Some expenses, like the need to replace a vehicle every 6 years or so, can be anticipated and planned for by setting up a sinking savings fund to prepare for the expense. But others may come out of the blue and have the potential to completely derail the family budget. Example: Emily, a single mother of 35 with 2 preteen children, suffered a debilitating stroke last year. Not only has she been unable to work and earn an income ever since, she had to spend $75,000 to modify her 2-story home to accommodate her motorized wheelchair. The combination of income loss and medically related expenses have depleted her savings and much of her RRSPs and driven her into debt. The prospect of having to sell her house and move the family into an apartment is looming. 1.1.2.2 Loss of income. During a person's working years, especially the early years, financial success and security are all about income. Unless someone wins the lottery or inherits young, the only way that they can accumulate savings or a long-term asset base is by generating more income annually than they currently need to live on. But income is dependent upon both availability and the individual's ability to continue working. And even those with jobs could suddenly find themselves without income if injury or illness caused a disability that kept him off the job for a prolonged period of time. 1.1.2.3 Loss of savings. Either unplanned large expenses or a decline or loss of income, or both, could compel a family to draw down their savings to meet current demands. And depending on the amount of savings involved and the family income resources available, it could take years to build them up again. 1.1.2.4 Lower standard of living. A lower standard of living is not really a risk in and of itself, but it may be a consequence of other losses. Loss of income, loss of savings, loss of assets, etc., which in turn may all stem back to income lost or unexpected medical expenses incurred due to injury or illness. This domino effect could often be avoided if the client has an effective A&S insurance program in effect. Otherwise, changing financial circumstances could compel the family to sell one of their cars, move to a smaller home or a rental unit, or cut back on, or eliminate, family vacations. And a reduced standard of living isn't merely a physical change for the family. It could also create psychological changes that are a roadblock to ambition and productivity in the future. A reduced standard of living today could translate into substantially reduced income, assets and lifestyle in the future. 1.1.2.5 Inflation. Using the Consumer Price Index, CPI, as a guide, for example, a basket of goods that cost $100 in 2000 cost $143.41 just 20 years later. In 2020, an increase of 43%, and that during a period of historically low inflation. Looking at the long term, $100 worth of goods bought in 1920 cost $1,173. 1 century later. Although inflation in Canada has been historically low over the past years, 1.95% in 2019, it was not so long ago that it was at a much higher level, 12.12% in 1982. For those earning a living in times of high inflation, salaries have to increase substantially year over year just to allow the worker to maintain his standard of living. Likewise, disability income. Replacement products, like A&S disability insurance, need to be indexed to inflation in order for benefits to retain their buying power, particularly during periods of prolonged disability and/or high inflation. 1.1.2.6 Longevity. Life expectancy in Canada has greatly improved since the early 20th century. The life expectancy at birth for men has increased by 20.5 years, from 58.8 years in 1920 to 1922 to 79.3 years in 2009 to 2011. During the same period, the life expectancy of women increased by 23.0 years, from 60.6 years to 83.6 years. In 1920–1922, Canadian men who had lived to age 65 could expect to live for 13 more years, and women could expect to live for 13.5 more years, to age 78.0 and 78.5 respectively. In 2009 to 2011, 65-year-old men were expected to live until they were 83.8, while 65-year-old women were expected to live until the age of 86.7. This means that from 1920 to 1922 to 2009 to 2011, the life expectancies of 65-year-olds increased by 5.8 years for men and 8.2 years for women. 3. In general, people are living longer and spending more years in retirement. As a consequence, clients are going to need to accumulate more retirement assets than in the past if they want to avoid outliving their money. Increased longevity has the same implications for care costs for the elderly. Those who live longer are more likely to incur health complications requiring in-home or institutional care and are likely to require that care for a longer period of time than in the past. Both sound reasons to ensure that a strong long-term care insurance program is in place. Not only has the average lifespan of retirees increased by over 50% over the past century or so, but so has the cost of living longer. In 1900, most people who lived well into their 70s, but who had health problems, were cared for at home by their families. Today it is more common for the elderly who are in need of care to live in chronic care facilities, retirement homes, or nursing care facilities, with nursing home costs running as high as $5,000 a month, with monthly fees for private retirement homes often running much higher than that. Many seniors may well be faced with outliving their money and being dependent on the government or their children. In any event, many will find themselves in the position of being able to leave a much smaller, or no, estate for the benefit of their children. 1.1.2.7 Debt. Debt can insidiously erode financial plans and goals. Debt, of course, reduces net worth, the value of a person's assets less his liabilities. Average household debt in Canada in 2017 rose to $1.70 of debt for every $1 of family disposable income. Overall, in 2017, Canadians owed $1.4 trillion in mortgage debt and $630 billion in credit debt. 4. But it is not just the amount of debt that is a concern, but the carrying costs on that debt, most particularly credit debt. For example, consumer credit cards often carry annual interest rates on unpaid balances in the 18% to 24% range, or higher. At that rate, the $630 billion of credit card debt could have servicing costs in the range of $110 to $150 billion annually. In fact, many Canadians who are entering retirement carry substantial debt load, an impediment to the long-term financial viability of their retirement plans. Debt servicing, interest and minimum payments, usually comes out of current income, and current income may be put at risk in the event of health problems, like disability or critical illness. A client's failure to service debt could, in the extreme, result in lawsuits, foreclosure and bankruptcy unless insurance is put into place to replace the client's own capacity to generate income or cover current medical costs. 1.1.3 Personal risks that threaten individuals and their families. Aside from all the financial risks discussed above, people also face personal health risks that could derail their financial plans and imperil their financial security, such as likelihood of disability, loss of independence and costs of long-term care. 1.1.3.1 Likelihood of disability. In 2017, 1 in 5 Canadians, or 6.2 million people, aged 15 years and older had at least one activity-limiting disability, according to the results of the Canadian Survey on Disability, CSD, 2017.5. Persons were identified as having a disability if they had difficulty performing tasks as a result of a long-term condition or health-related problem and experienced a limitation in their daily activities. The prevalence of disability increases steadily with age in Canada. However, over 540,000 youth, aged 15 to 24, 13%, had at least one disability. In comparison, 20%, or 3.7 million, of working age adults, aged 25 to 64, and 38%, or 2 million, of seniors aged 65 and older had at least one disability. Women, 24%, have a higher prevalence of disability than men, 20%, and this was the case for all age groups. In 2017, 57% of Canadians with disabilities had a less severe disability, classified as having a mild or moderate disability, and 43% had a more severe disability, classified as having a severe or very severe disability. In all cases, the disability was severe enough to limit their activities to some degree. 1.1.3.2 Loss of independence and costs of long-term care. Lastly, with people living longer and in receipt of better health care than in the past, there are more persons living for more years with medical conditions, both physical, stroke, Parkinson's disease, for example, and cognitive, like Alzheimer's, that leave them unable to care for themselves independently. Many of these people rely on long-term care facilities for basic daily living. 1.1.4 Needs met by accident and sickness insurance for individuals. In the event of illness, injury or medical necessity, accident and sickness insurance can provide needed funds to buy time for employees, the self-employed, business owners and their families. Time to recover and return to productivity, time to adapt to a changed health status and time to weather the storms of an unexpected financial burden. As such, the needs met by A&S insurance for individuals include protection for Black small square income, Black small square savings, Black small square assets. 1.1.4.1 Protection for income. Although perhaps not immediately apparent from the title, Accident and Sickness Insurance, one of the most common forms of coverage is disability income protection, insurance that will replace a percentage of a person's regular income from employment or self-employment if the life insured is ill or injured and unable to work, after a suitable waiting period following the onset of disability, during which no benefits are payable. The insured will receive a monthly income payment from the insurer. The benefits will be payable for a prescribed benefit period or until the disabled insured is able to return to work, whichever comes first. Example: Raoul is an independent contractor working in the plumbing trade, earning $80,000 a year. In order to protect his family financially, in the event that he becomes disabled for a period of time and unable to work, he has taken out a disability income replacement, A&S, insurance policy. The policy has a 90-day, 3-month, waiting period, a tax-free monthly benefit of $4,000 and a 5-year benefit period. If Raoul was to be injured and unable to work, after waiting for 3 months, the policy would begin to pay him $4,000 a month for up to 5 years, to replace income lost due to disability. 1.1.4.2 Protection for savings. During a person's working lifetime, one of the many family goals is the accumulation of capital. Savings, in bank accounts, term deposits and other short-term financial vehicles, as an emergency fund or for near-term financial goals, like an education fund, a boat or a new car, etc. And investments, stocks, bonds, mutual funds, RRSPs, for longer-term goals like retirement. Unforeseen circumstances, sickness, disability, medical expenses, etc., can lead to the erosion of both short-term and long-term savings. Fortunately, extended health insurance, which is a form of accident and sickness insurance, can defray the financial impact of many of these risks by providing needed cash to replace lost income or pay medical bills. Example: this has been an unusually difficult year for the Johnson family. Mrs. Johnson, who runs a consulting sole proprietorship business, was injured in a slip and fall accident in January and was unable to work for 8 months. As a result, she was unable to earn her regular $5,000 a month of consulting fees for those months, resulting in a nearly 50% reduction in family income. The Johnsons' son was hit in the mouth with a puck in a recreational hockey game and required over $10,000 of reconstructive dental surgery. And the Johnsons' daughter developed a serious viral infection requiring 10 days of hospital treatment in a private room, at a cost of $125 a day. 10 times $125 equals $1,250. Fortunately, Mrs. Johnson has individual disability insurance in the amount of $3,000 a month with a 3-month waiting period. Her 8-month disability was covered by $15,000, 5 months times $3,000. In addition, the extended health care plan of Mrs. Johnson's employer reimburses the children's hospital expenses. Without this coverage, the Johnsons' savings would have been reduced by $21,250, $1,250 plus $5,000 plus $15,000. 1.1.4.3 Protection for assets. Most people save for their retirement, although amounts saved vary. For example, according to a survey published by the CBC, 6 on September 13, 2017, 65.2% of Canadians put aside money for retirement in 2015 by making a contribution to either a registered pension plan, an RRSP or a TFSA. And those assets, among others, do not necessarily get consumed during the retirement years. They are often passed on to the next generation through the retirees' estates. Or, at least, that is the intent. Unfortunately, health issues in the senior years can bring expenses that deplete retirement and estate assets. Most retirees' group health benefits terminate at retirement, leaving them without coverage for dental and vision care expenses. The Canadian Life and Health Insurance Association reminds us that, depending on the province of residence, a place in a long-term care facility generally costs from $900 to over $5,000 per month. It all depends on the type of room and the funding offered by the provincial plan. 7. Critical illness and long-term care insurance can provide benefits to offset much of these costs, permitting the senior to maintain the value of his estate, to pass on to his heirs. Example: Eudora, age 69, worked her whole life as a legal assistant, but never earning a large salary. She had no pension plan at her place of business, but did manage to accumulate about $250,000 in RRSPs and non-registered investments, in addition to her $150,000 home in rural PEI. To date, she has been able to live off of her $1,250 a month, $15,000 a year, in government benefits and some interest and dividends from her investments. Eudora recently discovered that she has a degenerative disease that will force her to move into a nursing home, at a cost of $2,750 a month, $33,000 a year. Despite her health problems, Eudora has a normal life expectancy of age 85, 16 years. The shortfall in her income versus the cost of the nursing home would require Eudora to liquidate $18,000 a year of her assets, $33,000 to $15,000, reducing her estate by about $290,000 over her lifetime. $18,000 times 16 years, money she had planned to leave to her 3 grand nieces, to help them to get a start in life. Fortunately, Eudora took out a long-term care policy when she was in her mid-50s. The policy will cover $1,000 of her monthly expenses, $12,000 annually, reducing the erosion of her estate by $96,000 over her lifetime. $18,000 to $12,000 times 16 years equals $96,000, and enabling her to still leave a substantial legacy for her family, the balance of her RRSPs and non-registered investments, as well as her country home. 1.2 for business owners. The needs and goals of business owners that require protection are, in many ways, similar to those of individuals and their families. That is because the business owner does not exist in a vacuum. He is both an individual and, often, a member of a family. The sections below describe goals, risks and needs of business owners as they relate to accident and sickness. 1.2.1 Goals. All owners of private businesses typically have similar goals, which may change with circumstances and over time. The goals for the business owner translate directly into individual goals. Black small square business profitability, income protection. Black small square business succession, capital protection. Black small square sale at fair market value, protection of estate value. 1.2.1.1 Business profitability. At the outset of a new business, simple survival is often the immediate goal of the business owners. Once the business gets through the first year or two and has established itself, the goal of the owners shifts from survival to profitability and growth. Whatever else their motives, business owners are in business to earn a living, for themselves, their families and their employees. Among the many factors that contribute to profitability is business continuity. 1.2.1.2 Business succession. Many business owners consider their business to be their legacy, to carry on their reputation and identity beyond their working lives. And many of those would like to see the business eventually taken over by their children. This is true whether those children are indeed children, perhaps currently preschoolers, are in university, or are currently, or prospectively, employed in the business. However, the majority of family-owned, private businesses do not transition down to the next generation, primarily because of a lack of planning. Even where the children might be willing to take over the business, a lack of proper preparation on the part of the family members wanting to take over can result in the business failing before any transition can be finalized. Chapter 5 of this manual outlines the role of accident and sickness, A&S, insurance to provide funds to cover the business operation expenses of a disabled owner, to ensure that he has a business to return to or to pass along to the next generation. 1.2.1.3 Sale at fair market value. In many cases, the business cannot be passed down to the next generation. There is no next generation, or the next generation is not capable of taking over the business. The members of the next generation cannot agree on how to divide up or carry on the business, or the next generation simply has their own life plans and are not interested in taking over the business. In such cases, the next best scenario is for the retiring owner, or the estate of a deceased owner, to be able to sell the business for its fair market value. This can usually not be accomplished without forward planning. A spur-of-the-moment sale, unplanned, is often a fire sale, with potential successes. Or competitors looking to take advantage of the situation by paying a fraction of fair value for the business itself, its client, customer base, or the hard assets of the business. Ideally, owners should take the time to identify in advance a suitable buyer for a business, lock in that buyer and a fair price with appropriate legal documentation, and ensure that adequate funding will be available when needed to provide for the purchase. Chapter 5 of this manual examines the role of accident and sickness insurance in securing the necessary funding, along with proper legal documentation, such as a buy-sell agreement, to ensure that a disabled business owner can obtain a fair price for the business. 1.2.2 Business risk. Business success or failure can be related to a number of factors, both internal and external. Such issues as productivity, quality of production, and the management of finances and personnel are internal matters, subject to the control of the business owner. Risk is generally defined as the business. 1.2.2 Business risk. Business success or failure can be related to a number of factors, both internal and external. Such chance that a given result, usually negative, might occur. Risks may be systematic, common to the business environment itself, or unsystematic, unique to the client's business itself. Businesses are, first and foremost, exposed to business risk, also known as unsystematic risk. Factors that relate to a specific business, rather than to the market or the economy as a whole, that could impact profitability, or even survival, of the business.
1.2.3 Risk management. When it comes to the risk that a business might suffer when an owner or an essential employee is injured or ill and unable to fulfill his function with the business only has two options to deal with the costs associated with such a risk: self-funding, insurance. 1.2.3.1 Self-funding. Self-funding risk is simply a form of risk retention assumption of the cost of the risk by the business owner. An individual who wishes to self-fund the cost of a loss associated with a risk really only has three options: pay the cost out of current cash flow, borrow to acquire funds to pay the cost, erode savings, or sell assets. None of the options is very appealing. If the cost of the loss is the reduction or elimination of earned income due to disability, where is the current cash flow to come from to pay for it? Borrowed funds could be used to pay for the loss, but borrowing money can be expensive and the funds have to be repaid. If the borrower happens to be ill and unable to work, lenders may not find him to be an attractive risk. Where would he get the cash flow to repay the loan? Savings or other assets could be sacrificed to pay for the loss, provided that the individual has the necessary assets. But those assets were likely earmarked for other purposes, needs that might go wanting now or in the future. 1.2.3.2 Insurance. The better solution than self-funding is often to insure against the potential loss posed by risks such as death, disability, or medical expenses triggered by injury or illness. For a modest premium paid regularly to the insurance company, an individual can be assured that funds will be available when needed to replace income lost or expenses incurred due to disability or a medical crisis. Of course, the premiums paid for insurance may be lost if the insured person never needs to file a claim, but the cost of this loss is likely to be less than the loss that would be incurred if no insurance was present. Conventional wisdom usually says that, with insurance, it is better to have it and not need it than to need it and not have it. 1.2.4 Needs met by accident and sickness insurance for businesses. Businesses, particularly smaller, private businesses, all rely upon two common factors for success. Ongoing revenue generated by the efforts of owners and/or key employees of the business and hiring and keeping quality employees. If a business relies extensively upon the services of the owner or a key employee to generate the revenue needed to pay bills and turn a profit, a disability of more than a few days of such a person could spell the death of the business. Even if little or no revenue is coming in, expenses like rent, utilities, staff salaries, and other payables still need to be met. Specific ANS insurance policies, such as business overhead expense, BO, plans, among others, can provide funds to keep the business afloat financially for several months while the disabled owner/employee recovers. Example: Ingrid is the sole owner and primary salesperson for a small import/export business that rents office space in an industrial mall and employs 3 staff. Last month, she was in an automobile accident and was injured severely, enough that she was off work for 7 months. During the period of her disability, which promised to be temporary, the income of the business declined by 70% after the initial couple of months. Without cash flow, the business would be forced to close its doors. However, Ingrid had the foresight to take out a BO disability insurance policy for her business, which would pay out up to $15,000 a month to cover ongoing business expenses. The funds were sufficient to pay the rent and staff salaries and keep the business operating until such time as Ingrid was able to return to work. There are many components that serve to attract and retain employees: salary, pensions, good working conditions, good management, positive management, and employee relations, and attractive benefits, including accident and sickness insurance. An employee wants to know that if he has to be off work for a period of time due to accident or illness, his income will continue during his absence to support him and his family. Even single employees would like to see health care benefits, dental, vision, extended hospital care, to cover medical expenses, a need that is even more important for those employees with families. If a prospective, or current, employer does not offer adequate employee benefits, employees, or prospective employees are likely to look elsewhere for employment security. Chapter 2. Insurance to protect income. Competency component. Analyze the available products that meet the client's needs. Competency subcomponents. Analyze the types of contracts that meet the client's needs. Analyze the riders that meet the client's needs. 2. Insurance to protect income. Disability insurance provides financial protection to working individuals who become injured or ill and unable to work. Benefits paid to or on behalf of qualifying insured individuals range from income replacement to paying monthly mortgage, loan, and credit card payments on behalf of the disabled claimant. 2.1 Sources of income protection. There are many sources of disability insurance, DI, coverage available in the marketplace. Anyone who has earned income, from employment or self-employment, and who is insurable medically, may obtain disability income replacement coverage from one or several of the following sources. Personally owned policy, acquired directly from the insurance company. Group insurance coverage, as an employee or as a member of a union or association offering group insurance coverage. Creditor insurance, including mortgage disability insurance, offered to borrowers or credit card holders dealing with major financial institutions. Provincial workers' compensation boards. Disability pensions offered through the Canada or Quebec pension plans. Employment insurance, EI, from the federal government, disability benefits portion. Société de l'Assurance Automobile du Québec, SAAQ, offering income replacement after a car accident. 2.1.1 Individual disability insurance. Individual DI contracts are entered into directly between the applicant, who is also both the insured, and the life insured aid under the contract, and the insurance company. Once the policy is issued, the policy holder is typically the premium payer, the life insured and the beneficiary under the policy. These policies are usually taken out to replace earned income in the event of disability, but may also have business use purposes, such as insuring against financial loss in the event of the disability of a key employee or of an employer in a small business. Insurance for business uses. Addressed in Chapter 5. Generally speaking, premiums payable under personally owned, rather than corporately owned individual DI policies are not deductible for income tax purposes, but then benefits are not a taxable receipt. 2.1.2 Group disability insurance. Group disability insurance is provided to many individuals, plan members, under the umbrella of 1. Group policy. In the case of an employer/employee group plan, the most prevalent type, the employer is the policy holder and the employee is the life insured and the beneficiary. Group coverage is priced based on the underwriting characteristics of the group as a whole, rather than the individual lives insured. This is explained in more detail later in this chapter. 2.1.3 Creditor insurance. A number of commercial lenders, creditors, offer their clients, borrowers, DI coverage designed to pay scheduled or minimum loan payments in the event that the insured borrower should become disabled and unable to work. The coverage is provided through an affiliated or other third-party insurance company. In the case of an insured traditional loan, the insurance would pay the scheduled monthly loan repayment on behalf of the disabled borrower. In the case of credit card loans, the insurance would pay the minimum monthly required payment for the disabled borrower. These plans typically have at least a 90-day waiting period and a stringent definition of disability. 2.1.3.1 Mortgage disability insurance compared to individual disability insurance, traditional. A specialized subsection of creditor insurance is the mortgage DI market. Mortgage disability insurance is normally provided through the lending institution, the mortgagee, on the life of the borrower, the mortgager, to ensure that the monthly mortgage payment will be made during a time of disability of the borrower. Alternatively, the borrower might take out an individual disability income replacement policy, with the intent of using part of the monthly claim proceeds to make the scheduled mortgage payments. Both approaches have their strengths and weaknesses, as illustrated in Table 2.1. Generally, mortgage disability insurance arranged through the lending institution is less expensive and has less stringent underwriting requirements, but individual disability insurance offers more flexibility to the policy holder, who can use the benefits for other things besides paying the mortgage. For example, it can also be used to compensate for loss of income due to disability, or to make monthly payments on a variety of combined loans such as a car loan, student loan, home improvement loan, line of credit payments, and even to be set aside for monthly savings, etc. The insurer does not restrict or dictate how the beneficiary can use an individual disability insurance benefit. The benefit can be used for any purpose as soon as the money is received. See Section 2.2.3.3 of the Manual for Disability Definitions. Table 2.1. Comparison of mortgage disability insurance and individual disability insurance coverage. Mortgage disability insurance, individual disability insurance. Type of policy group term, client is included in the creditor's group insurance plan. Individual, to age 65. Insurer, lending institutions, insurer selected by the life insured. Policyholder, lending institution, life insured. Life insured borrower, client, life insured. Underwriting limited, no medical exam, full medical exam. Definition of disability, total disability only. Any occupation *. Total, partial, residual disability. Own occupation, regular occupation. Any occupation *. Premium levels: lower premiums based on group. Underwriting. Higher premiums based on individual. Underwriting. Premium payer: borrower, client, life insured. Beneficiary: lending institution, life insured. Use of benefits: monthly mortgage payments as the life insured sees fit. See Section 2.2.3.3 of the Manual for Disability Definitions. 2.2 Individual, personally owned, disability insurance. There are various types of individual, or personally owned, policies, each defined by the benefits it offers, the factors used to calculate premiums, and the riders that may be added to it in order to customize the coverage offered. Point 9. 2.2.1 Types of individual policies. One of the ways that individual, or personally owned, policies can be differentiated from each other is by the level of guarantees afforded the policyholder in the contract. These can range from an absolute guarantee that the policy can never be altered or cancelled, or the premium increased during the lifetime of the policy, to contracts with a lower guarantee that can be cancelled at any time by the insurer. The most common types of contracts are the following: non-cancelable policies, guaranteed renewable policies, cancelable policies, guaranteed issue policies, non-traditional disability insurance plans. 2.2.1.1 Non-cancelable policy. Non-cancelable, non-can, policies offer the policyholder the highest level of guarantees. These plans are sometimes referred to as non-cancelable and guaranteed renewable contracts. The rights afforded the policyholder are virtually incontestable for the life of the contract, which is usually to age 65. The policy cannot be cancelled unilaterally by the insurance company. The policy premiums cannot be increased. Policy benefits cannot be reduced or modified. The insurer is compelled to renew the life insured's policy annually until the age of 65. Only the policyholder has the right to modify the policy, subject to underwriting if applicable, prior to its maturity. Once the policyholder turns 65, he typically has the option to convert the policy, without medical evidence, to a guaranteed renewable contract with a shortened benefit period, usually only a year or two. The converted policy will have premiums based on the insured's age at time of conversion, and will typically run to the insured's age 72 or 75. Since the benefit period is reduced to 12 or 24 months, premiums will remain reasonable even if the insured is over 65 years of age. 2.2.1.2 Guaranteed renewable policy. Guaranteed renewable policies bind the insurer to renewing the coverage each year until the maturity date of the policy, usually at age 65, but the insurer has the right to modify premiums unilaterally. The policy of an individual insured cannot be changed. Any alterations must apply to the entire class of policies, impacting all lives insured under that contract type. Any changes to the contract must be communicated to the policyholders, in writing, at least 30 days before a change or cancellation takes effect. The changes are initiated at the time of the annual policy renewal, if at all. 2.2.1.3 Cancelable policy. Cancelable policies offer the fewest guarantees for the policyholder. These policies can be modified by the insurer without the life insured's consent. The insurer may change the benefits and premiums based on the claim experience of a given group of insureds or type of insured. The change will apply, without the insured's consent, not to just one insured but to all the insureds of that group or type. In fact, the insurer could unilaterally cancel the policy. The only constraint on the insurer is that the policy of just one individual insured cannot be changed. Any alterations must apply to the entire class of policies, impacting all lives insured under that contract type. The contract will require that the insured be advised in writing prior to a policy change or modification. A minimum of 30 days in advance. Because of the lack of long-term certainty afforded the policyholder, all other factors being equal, premiums for cancelable contracts will be lower than those for guaranteed renewable policies, which in turn are lower than those for non-cancelable guaranteed renewable policies. These policies are most often issued to higher-risk occupational classes, such as laborers or taxi drivers, or for insureds who are declined on previous policy types, or for those seeking the lowest premium. Example: Jean-Marc is insured under a non-cancelable guaranteed renewable disability insurance policy. 4 years ago, Jean-Marc developed severe depression and had to claim disability insurance benefits. Today, he is back at work, but is still undergoing treatment for his disability. Recently, Jean-Marc asked his insurer to increase his coverage on his existing policy. The insurer refused to do so, but proposed that the additional coverage be provided under a cancelable policy. This decision was based on his claim, which increased his risk. As this example shows, sometimes the only way to insure a high risk is with a cancelable policy, where the pricing is more flexible but the claim is more restrictive. 2.2.1.4 Guaranteed Issue Policy. A few insurers currently offer guaranteed issue DI plans. These plans involve individually issued policies that are an alternative to traditional long-term disability, LTD, group insurance coverage, and are available to groups in the low-risk occupational classes of executives and professionals, lawyers, doctors, accountants, etc. These plans guarantee coverage for members of the target group. Because of the guaranteed nature of the plans, they are subject to a number of possible restrictions based on size of the group, occupational class of the group members, minimum annual premium commitment, minimum average age for the group members. The guaranteed issue plans typically carry a higher premium than traditional group insurance coverage, and the insurer generally has the right to terminate the guaranteed aspect of the plan at any time by refusing to accept any further lives insured on a guaranteed basis. Guaranteed issue plans are generally available in two forms: guaranteed standard risk, guaranteed to issue. Both types of plan typically require that the applicants must work a minimum number of hours per week and must be actively at work, not on disability claim, at time of application. Guaranteed standard risk. These plans guarantee not only that they will issue coverage, but that they will issue the policy without any coverage restrictions or premium ratings. There will usually be extra restrictions on the administration of the plan, such as a requirement that 100% of the members of the group in question must participate in the insurance coverage, to limit anti-selection, 10, or that 100% of the premiums must be employer paid. Guaranteed to issue. These plans guarantee to issue some form of coverage, but not necessarily exactly the coverage applied for. The insurer generally requires full medical underwriting and reserves the right to apply premium ratings or exclusion riders to accommodate non-standard risks. 2.2.1.5 Non-traditional disability insurance plans. With the advent of the 21st century, Canada has experienced a significant growth in the percentage of workers who define themselves as self-employed contract workers. By 2021, the self-employed represented 14.14% of the Canadian workforce. 11 This is a dramatic shift from the primary market of employees that the disability insurance industry has traditionally served. Changing markets require changing products to serve them. Although many contract workers, who typically receive no benefits from their employers, may be looking for standard disability coverage, others find that sickness coverage is too expensive or that it requires too long a waiting period to be of practical benefit to someone whose income would stop immediately if they fell ill. Many of these self-employed workers would prefer just an affordable injury, accident policy that would offer first-day benefits. To accommodate this market, some insurers have separated the accident and sickness elements of their DI policies, offering contracts that insure against loss of income due to one cause or the other, but not both. Other adaptations are changing definitions of disability. Some policies have changed the requirement for total disability to the inability to perform specified functions, rather than job duties. Since workers who are not employees are offering skills and services, rather than being restricted to specified duties. That is to say, the contract worker is not bound by a job description that defines those things which he is obliged to do for the benefit of an employer, duties. Rather he offers a range of skills, example marketing, authorship of texts or reports, actuarial consulting, which the principal, his employer, can choose to avail himself or not. Still other companies are offering an income-based definition of disability, the inability to earn a certain percentage of regular income due to disability, recognizing, again, that job functions may vary from contract to contract. Policies are even now available for the self-employed workers who are unemployed currently, not under contract. The definition of disability then becomes the inability to seek new contracts due to disability arising from injury or illness. And some insurers will even offer limited benefits to those who do not have gainful employment. Individuals who provide full-time care to their children at home, perform volunteer services or are natural caregivers, for example. The policy will provide the insureds with limited monthly benefits, while disabled, to enable them to contract out the services they were previously providing. As self-employment and contract work become more and more the option of choice, or a necessity, for workers in the 21st century, and as workers push the end of their working lives beyond age 65, products will continue to evolve to meet their changing needs. 2.2.2 Individual policy benefits. Disability income replacement policies provide monthly income benefits to lives insured should they meet the definition of disabled under the policy, but the disability landscape is more complex than just that. Disability insurance, DI, policies vary as to the amount of benefit paid, when benefits commence and for how long benefits might be payable, if they are payable at all in the circumstances. 2.2.2.1 Amount of benefit. One of the risks is that an insured will act differently because insurance is in place. In the case of disability insurance specifically, by being or claiming to be disabled, or to still be disabled, an insured individual could potentially earn an income without having to work. One way of minimizing the risk of this occurring is to ensure that the insured person will not be better off financially while on claim than he was when he was working. Personally owned DI policies normally pay a tax-free disability benefit, allowing for income tax and other benefits normally applicable to income from business or employment. Many insurers will not issue coverage that would pay the disabled life insured more than 60 to 66.66% of their net pre-tax, pre-disability income. Moreover, the benefit will be tax-free. This is a relatively simple calculation when the insured's only source of income is salary or self-employment income. Example: Heinrich is a sole proprietor, working as a consulting computer technician. Most years, he earns $70,000 in consulting fees and has about $12,000 in business expenses which are only incurred if he is working. After allowing for income taxes annually, he gets to keep roughly $38,000 of the $70,000 that he earns. Based on his pre-tax income of $70,000, less $12,000 of deductible business expenses, an insurance company would offer him maximum DI coverage of about $34,800, $70,000, $12,000 times 60%. This is close to the $38,000 that he gets to keep, after tax, while he is working. He is financially neither advantaged nor disadvantaged if he is on a disability claim, minimizing the chances that he would submit a false claim or artificially prolong a valid claim in order to continue receiving an income without working. The computation of maximum allowable benefit becomes more complex if the life insured had sources of unearned income that will continue during a period of disability, in addition to his earned Income. Example, Kant. Consider the case of Heinrich, above. Assume that, in addition to his earned income of $70,000 a year, he has income from a family trust of $20,000 a year. Income that will be paid to him whether he is working or not. If the insurance company were to ignore the trust income and issue him $34,800, or 60% of $70,000, $12,000, of disability protection, during a period of disability, he would receive $34,800 a year from the insurance company and $20,000 from the trust, or $54,800 a year of total income, almost 78% of his gross, pre-disability earned income as a consulting computer technician. There would be little incentive for Heinrich to return to work. Even if the insurance company were to include the $20,000 of trust income in Heinrich's computation of earned income, he would end up being over insured. 60% of Heinrich's total income of $78,000, $58,000 net in fees plus $20,000 from the trust, equals $46,800 a year in disability benefits. However, Heinrich would still be receiving the full $20,000 from the trust, making his total income while on disability claim $66,800. This would represent about 86% of Heinrich's pre-disability income, well in excess of the 60% threshold that would place him in a neutral position. The way that many insurers deal with this problem is to treat the ongoing, non-earned income source as if it were part of the disability benefit and reduce the coverage offered accordingly. Example, Kant. In Heinrich's case, the insurer would be willing to insure a benefit equal to 60% of Heinrich's total pre-disability income of $78,000, or $46,800. However, the coverage offered would then be reduced by the $20,000 of trust income that he would still be receiving while disabled, leaving a benefit of $26,800. The combination of the disability benefit and the trust income would then total $46,800, or 60% of Heinrich's total pre-disability income of $78,000. 2.2.2.2 Waiting period. Most DIP policies have a waiting period, also often called the elimination period, which is a time frame between the onset of disability and the commencement of benefits under the policy. The primary purpose of a waiting period is to eliminate the need for the insurance companies to process claims of very short duration, which require a significant amount of administrative effort and expense on the part of the insurance company in relation to the insured's lost income and the benefits paid. Example: Alfred injured his leg in a fall while hiking on the weekend. He was unable to work for 8 months. His DIP policy has a 90-day waiting period and a 24-month benefit period, maximum. Because of the waiting period, the insurer paid out 5 months of benefits, 8 months of disability less the 3-month waiting period, rather than the full 8 months. Some policies permit a 0-day waiting period, but waiting periods of 30 days to 12 months or more the norm, with a 90-day waiting period being the most common. The shortest waiting periods are often available only to insured individuals in the highest, less risky occupational classes. All other factors being equal, policies with a longer waiting period will charge lower insurance premiums. The waiting period has no effect on the benefit period when the benefit period is less than 65 years. Example: Alfred injured his leg while hiking on the weekend. He was unable to work for 30 months. The waiting period under his DIP policy is 90 days and his benefit period is a maximum of 24 months. As a result of this waiting period and the duration of the benefit period, the insurer paid all 24 months of benefits. 30 months, 3 months, waiting period, equals 27 months of disability, of which only 24 months are covered. 2.2.2.3 Benefit period. The benefit period under a DI policy is the maximum duration for which benefits will be payable. The benefit period starts once the waiting period has expired and benefits run until the insured is well and able to return to work full-time, or the benefit period has expired, whichever comes first. Generally, each instance of disability is treated individually and the full benefit period could apply to each disability. For example, under a policy with a 2-year benefit period, the insured might be disabled more than once over the life of the policy and could claim up to 2 years of benefits for each disability. The most common benefit periods for long-term individual disability income replacement policies are 2 years, 5 years, 10 years, to age 65. However, as more and more Canadians are working beyond age 65, some insurers offer coverage up to age 75 on an accident-only basis. Short-term disability, STD, insurance policies are more likely to have a benefit period of only 10 to 26 weeks, but this period may be longer in certain cases. The longer the benefit period, the greater the amount of claim the insurer is at risk of paying and the greater the policy premium will be. 2.2.2.4 Exclusions and limitations. Almost all policies contain provisions for standard, common exclusions, causes of disability for which no benefits will be payable. These exclusions are not specific to the health, vocation or lifestyle of a specific insured, but apply to all persons insured under that type of policy. The most common exclusions include disabilities arising from the following circumstances: war, whether declared or not; terrorist acts; self-inflicted injuries; attempted suicide; participating in illegal activities; normal pregnancy and delivery. The underwriting departments could also limit their exposure to payout if they consider the life to be insured to be an unusual risk by imposing any one, or more, of the following limitations on the coverage applied for: reduction of the amount of monthly benefit; reduction of the length of the benefit period; increase in the length of the waiting period. 2.2.2.5 Denial of benefits. Life and disability insurance companies have a legal obligation to pay valid claims on in-force policies. However, a number of circumstances may arise where a claim is denied and no benefits are paid. Among the reasons for a denial of benefits are: misstatement of a material fact on the insurance application; fraud; absence of loss; absence of proof; delay in filing a claim; misstatement of a material fact on the insurance application. A policy may be voided, declared legally invalid, if, within 2 years of the date of policy issue, it is discovered that the insured made a false statement on the application or failed to disclose information that was material to the underwriting process. This 2-year period is called the contestability period. The rationale for voiding such a contract is the assumption that the policy might never have been put in force in the first place, had the insurance company been in possession of all relevant facts at the time of application. A material misrepresentation is one involving a fact that would/could have impacted the underwriting decision, such as disclosure of a previous back injury. Fraud. If the misrepresentation was accidental, the applicant forgot about a health factor or honestly thought it not to be important, then no fraud is deemed to have taken place. However, if the applicant purposely misstated information or failed to disclose information with the intent of trying to deceive the insurance company to issue a policy it might otherwise not issue, then a fraud against the insurer has occurred and the insurer has the right to void the policy at any time, even many years after policy issue. Similarly, if the insured commits fraud at time of claim, makes a false claim, the insurer has the right not only to deny the claim, but to cancel the policy. Absence of loss. Benefits are only payable under a disability claim if the claim is proven to be valid and there is evidence of loss of income as a consequence of the disability. If the insured was unemployed at the time of occurrence of the disability or was earning considerably less than the amount he had been insured for, benefits might be reduced or denied. Entirely, in keeping with the actual level of loss, even though the disability itself may be valid. Example. Haroon took out a guaranteed renewable disability income replacement policy. In 2009, when he was earning $60,000 a year, which would pay him a $3,000 monthly benefit equivalent to 60% of his income, 12 times $3,000, divided by $60,000, if he were to become disabled. By 2014, Haroon had lost his former job and was now working for a different employer at a reduced salary of $48,000 a year. For similar work, if Haroon was to become disabled now, his maximum eligible monthly benefit would be only $2,400 a month, equivalent to 60% of his current salary, $48,000 times 60% divided by 12. Haroon should notify the insurer of his change in employment and income so that the insurer can reduce his premium to reflect his new coverage. Otherwise, his premium will remain the same, but he will only be entitled to reduced coverage based on his new salary in the event of disability, until he notifies the insurer. No refund of premium will be granted. Absence of proof. The disability that is at the heart of the claim must be proven medically. The insurance company will not simply accept the claimant's or the employer's word that he is disabled and unable to work. The insurer will, at a minimum, request a report from the insured's doctor and may ask for a medical exam or other tests from a physician of its choice. In the case of a prolonged disability, it is usual for the insurer to require periodic medical updates to ensure that the disability actually is persisting. Delay in filing a claim. Lastly, benefits may be denied if a claim is not filed in a timely fashion. Ideally, the insured should contact the insurer within 30 days of the onset of the disabling condition, even if it will be some time before a claim would warrant the payment of benefits because of the waiting period. In any event, the insured must generally file a claim, i.e., submit all medical documents and other reports to the insurer within 90 days of the onset of the disabling condition, but contracts and applicable legislation may vary. The disability insurance policy specifies the timeline during which a claim may be filed, and insurers have the right to decline claims that are not filed by the deadline specified in the policy. 2.2.2.6 Rehabilitation benefit. It is generally in the best interests of all parties involved if a disabled insured can return to work as soon as is safe and practical, best for the insured who will be back to work earning a full salary, best for the insured's employer who will regain the insured's services, and best for the insurance company, who will no longer have to pay the claim. For all of these reasons, the insurer will encourage the disabled insured to take steps to get well and back to work, including receiving physical rehabilitation treatments, specialized medical treatments. Although retraining is not mandatory under DI policies, it is encouraged and will generally be paid for, in whole or in part, by the insurer, in addition to the benefits. The policy may specify a dollar amount that is available to the insured for retraining, provided the insurer accepts the choice of educational program. In some cases, an amount is also included for rehabilitation, specialized medical treatments, subject to insurer approval. The retraining and rehabilitative services for which the insurer will pay include, but are not limited to, physiotherapy treatment, occupational training, retraining, specialized medical treatment, job placement, psychotherapy. 2.2.2.7 Benefits for recurring disability. It sometimes happens that an individual who suffers a disabling injury or illness will return to work only to suffer a recurrence of the disability attributable to the same cause. Illustrates, if the policy has a fairly lengthy waiting period, the disabled worker could find himself subject to 2 waiting periods, with no benefits, over the course of a relatively short period of time. Example. Ophelia injured her back in January of 2014, in a fall on ice in the parking lot of the office where she works. She was off work for 5 months, collecting disability benefits for 2 of those months after allowing for the 90-day waiting period under her DIC coverage. 8 months after returning to work she was again placed on disability, this time for 4 months, as sitting at the computer all day aggravated her previous back injury. Since her return to work exceeded 6 months, she will have a new waiting period for her second disability even if it is identical to the first, back pain. In total, she will have received 3 months of benefits for 9 months of disability, 5 months of disability, 3 months of waiting period equals 2 months of benefits and 4 months of disability, 3 months of waiting period equals 1 month of benefits. The recurring, or recurrent, disability clause found in many DIC contracts is designed to prevent subjecting the insured to 2, or more, waiting periods, without benefits. The insured must qualify on 2 or more instances of suffering a disability attributable to the same cause within a short period of time. Most often a second period of disability that commences within 6 months of the termination of a previous period of disability, due to the same cause, will be treated as one instance of disability and a second waiting period will not apply. Example, Kant. In Ophelia's case above, if her policy contained a recurring disability clause, she would not be subject to a second waiting period if her return to work had lasted only 2 months, and her benefits would recommence immediately upon the onset of the second instance of disability. As such, she would receive 6 months' worth of benefits during the 11-month period, not 3 months, as stated in the previous example. The downside to a recurring disability clause can be the fact that the 2, or more, periods of recurring disability are treated as one for purposes of calculating the benefit period. Particularly, if the benefit period is relatively short, 2 to 5 years for example, this could significantly impact the total amount of benefits received due to a prolonged disability. Diagram 2.3 illustrates how benefits could run out before the end of the second disability period. WP refers to the waiting period. Example: Abdul has a DIP policy that will pay him 24 months of benefits, maximum, after allowing for a 90-day waiting period. He was injured and went off on disability. Claim lasting 8 months, receiving 5 months of benefits, after allowing for the waiting period. 3 months after returning to work he was forced to take an additional 24 months off due to the same cause of disability. Because Abdul's policy contained a recurring disability clause, and his return to work was less than 6 months before his second period of disability, he did not have to undergo a second 90-day waiting period when the second period of disability arose. However, the 2 periods of disability were added together, treated as one, for purpose of the 24-month benefit period. For the second disability claim, Abdul received only 19 months of benefits, not 24 months, because the 5 months of benefits he received under the first claim were deducted from his remaining benefit period. In this example, in order for Abdul not to be subject to a second elimination period, 2 conditions would have to be met. His second disability would have to occur more than 6 months after his return to work, and with the disability would have to be the same. Thus, the recurrent disability clause would not be applied. 2.2.2.8 Benefits for presumptive disability. Presumptive disability occurs when an insured suffers certain specified injuries or conditions which are deemed to be so severe that the person is presumed to be disabled, even if the disability does not result in a loss of earnings. The types of injury/condition are set out in the policy and would typically include total and permanent loss of hearing, total and irreversible blindness, loss of, or loss of use of, both arms or both legs or one arm and one leg, total and permanent loss of speech, In such instances, the normal waiting period under the policy is waived, benefits start immediately, and full total disability benefits are payable for the life of the benefit period, even if the insured is able to return to work full-time and even if he can now fulfill all of the duties of his previous employment at full salary. To qualify for presumptive disability benefits, unlike the case for most definitions of disability, the insured does not have to prove a loss of income due to the disability, only that the qualifying disability exists. Presumptive disability is a benefit offered in most, but not necessarily all policies. Example: Joaquim, a programmer analyst, has disability insurance that is non-cancelable until age 65 and includes a presumptive disability clause. While practicing his favorite sport, he permanently lost the use of both feet. He can still perform all the major tasks involved in his occupation and work in front of a computer screen in a seated position without losing any income. Because of the presumptive disability clause, he will be able to claim his disability benefits until age 65. He will therefore receive his income as a programmer analyst on top of his tax-free disability benefits. This is one of the few situations of an insured earning more money with disability insurance. 2.2.2.9 Survivor Benefit. Some disability policies offer a survivor benefit, payable to the insured's estate, should the insured die while on disability claim. In some instances, the policy requires a qualification period, such that a survivor benefit is only payable provided the insured had been disabled for a minimum period prior to his death, such as 12 months. The benefit is paid out in a tax-free lump sum, upon proof of death, and is usually equal to 3 times the monthly total disability benefit. Example: if the monthly benefit was $3,000, the survivor benefit would be a lump sum of $9,000. 2.2.3 Individual policy premium factors. Aside from the amount of monthly benefit requested, there is a wide range of factors that are taken into consideration in setting premiums for a disability income replacement policy, such as age of the insured, gender of the insured, health of the insured, smoker or non-smoker status, occupation, definition of disability used, claims history of the insured, length of waiting and benefit periods for the policy. These factors will be examined in the following pages and their impact on disability insurance. D. Premiums discussed. Other factors not related to a specific life insured are also taken into consideration in setting premiums, namely an estimate of investment returns on the insurer's accumulated premiums and general operating expenses. Most importantly, morbidity tables 12 must be taken into consideration in assessing and pricing the potential cost of taking on risk. These factors will be addressed later on in the manual. 2.2.3.1 Impact of gender and age. As with life insurance, both the gender and the age of the life insured are significant factors in setting policy premiums. In the case of gender, insurance companies' disability claims history illustrates that the number and length of claims is higher for women than men. Women are likely to pay higher premiums than males of the same age for the same coverage. And older applicants will likely be faced with higher premiums than young ones. 2.2.3.2 Health issues. The past or present health of a disability insurance applicant is a critical factor in the underwriting process. Standard premiums and benefits are based on the assumption that the applicant is a standard life, likely to face the same risks of disability as the average individual. If the applicant has had health issues in the past, or is currently ill or injured, he may be uninsurable, or would at least be subject to premium ratings or exclusion of coverage for specified causes of disability. 4. Example: if the applicant consulted a healthcare specialist within 1 year prior to the application, the condition that led to that claim could be classified as a pre-existing condition. Insurers will usually issue policies with a 1-year exclusion rider from the date of policy issue for claims relating to a pre-existing condition. Even the health of parents, grandparents, or siblings may come into the underwriting process if the applicant's family members suffered from conditions that are inherited or are likely to run in families, where, for instance, more than one family member may have had cardiovascular disease or breast cancer. Insurers gather relevant medical and health information on prospective insureds from a variety of sources. Non-medical form on the application. Attending physician's statements, APS, from the applicant's doctor. Paramedical exam from a nurse, if required. Full doctor's medical exam, if required. Blood, saliva, and urine samples. Data from the Medical Information Bureau, MIB. Inspection report from an investigator for lifestyle issue. 2.2.3.3 Definitions of disability. The definition of when an insured is disabled for purposes of disability insurance is not just a single one. Disability can be measured as partial or total, and within that range there are 4 distinct definitions that are employed by different policies. Own occupation. Regular occupation. Any occupation. Total disability, according to the CPP. With the exception of workers' compensation coverage, which deals exclusively with work-related injuries and illnesses, the cause of disability is generally not considered. There is one exception, however: some insurance policies only cover injuries. To be well protected. In case of disability, an insured must choose an insurance that covers both injury and illness. Otherwise, he could become disabled as a result of an illness and not get any benefits. Partial disability will be defined later in this chapter. Own occupation. The own occupation definition of disability is the most liberal in that it is the easiest under which to qualify as being disabled and receive disability benefits. With this definition, the insured is considered to be totally disabled if he cannot perform all of the primary duties of his regular occupation, even part of the time. There is no requirement that he return to work, either in his previous role or some other suitable role, until and unless he can perform all the primary duties of his regular occupation. While he meets the definition of disabled under own occupation, benefits will be paid, even if he has income from other work or duties. This other income will not be included in the calculation of his benefit and may even be considered an enrichment. Example: Tobias worked as a surgeon, earning $240,000 a year. 4 years ago, he was injured in his home workshop and lost all the dexterity in his right hand. As a consequence, he can no longer function as a surgeon and must claim disability insurance. After rehabilitation, Tobias took up a position at the local medical school, teaching other surgeons the techniques that he had developed. He also travels on the lecture circuit and has published 2 books since his accident. In total, he now earns $300,000 a year from his various enterprises. Since he can no longer perform the functions of a surgeon, he will continue to receive benefits under his DI policy, which has an own occupation definition of disability. This situation results in an enrichment of the insured, primarily because of the own occupation definition of disability. From another perspective, if Tobias had purchased disability insurance with the regular occupation definition, he would have claimed his insurance benefits reduced by his other business income, until it exceeded his insured income, thus reducing his insurance benefits to 0. Because of the generous benefits under an own occupation definition of disability, its availability is generally restricted to occupation classes with the least risks, those which are least likely to need to file claims. In comparison, all other things being equal, professionals who can adhere to an own occupation definition are eligible for a reduced rate per $100. They are least likely to need to file claims and tend not to stay on claim as long as other occupation classes. Example: if 2 policies were issued for the same amount of coverage $3,000 per month, the own occupation policy of high-income professionals would be less expensive than the any occupation policy of other occupation classes more likely to claim benefits. Regular occupation. Regular occupation uses essentially the same definition and has the same implications as own occupation, but with one difference: if the disabled insured elects to go back to work in any capacity, benefits from the policy will be reduced and could, in fact, be terminated. However, the insured is not compelled to return to any occupation, even if physically able. If he refuses to return to work, he will be entitled to his full benefits. But this choice is strictly up to the insured and not the insurer, who cannot force him to accept another job. The regular occupation definition of disability can be offered to almost all occupation classes. Any occupation. Any occupation disability insurance is the easiest to purchase. However, it covers fewer cases. To be considered disabled, the insured must be unable to perform the duties of any occupation appropriate to his skills or education. The insured can therefore be unable to do his job without the insurer considering him disabled. The any occupation definition is therefore available to most insureds, particularly those in high-risk occupation classes. On the other hand, if the disabled insured qualifies to work in a job that is similar or consistent with his education or occupation, with his current disability, regardless of whether he accepts that job, he will not be entitled to disability benefits. In a sense, the insurer is forcing him to return to work with no other choice. Total disability according to the Canada Pension Plan, CPP. Total disability under the Canada Pension Plan, CPP, 13 is essentially defined as the inability to perform the functions of any occupation for which the insured is suited by education and experience, on a total and permanent basis. The definition also implies that the insured will likely never recover and be able to return to employment and, in fact, will likely eventually die from the cause of the disability. Such a strict definition is seldom employed by individual or conventional group policies, but may be found more often in loan and mortgage insurance policies. 2.2.3.4 Occupational Clause. In underwriting disability insurance, the occupation of an applicant has a significant impact on whether the applicant is insurable, the type of policy available, the riders and benefits available, the cost, premium level, for the coverage. Certain occupations are inherently more susceptible to injury or stress than others and are therefore more prone to claims. In order to codify the risks that insurers are willing to assume, occupations are generally divided into occupational classes. Although different insurers use different methods of classification, the following is the most common. 4A. Professionals, such as doctors, lawyers, dentists, and senior executives. 3A. Administrative office workers who face few, if any, workplace hazards, such as clerical staff. 2A. Supervisors in low-risk environments, salespersons, and like occupations. A. Skilled manual workers who face few or no workplace hazards, or those working, for instance, as courier truck drivers. B. Manual laborers who work in hazardous environments, such as home construction workers. Aside from the simple issue of price, a 3A occupation would command a higher premium than a 4A occupation for the same coverage. There may be certain policy types or benefits not available to those in higher risk classifications. For example, an applicant in the 2A class would not usually qualify to acquire own occupation coverage or a non-cancelable contract. Because occupational class plays such a critical role in risk assessment and policy pricing, most DI contracts have an occupational clause that specifies that the insurance company has the right to increase premiums or adjust benefits if the insured changes occupations to one in a higher risk classification during the term of the policy. Example: Eunice took out a DI policy when she worked as an administrator in the office of a printing factory, a 3A classification. She paid $225 a month for her Insurance coverage. 5 years later, Eunice changed jobs with the same employer, and is now working as a staff supervisor on the floor of the printing plant, a classification job. Her policy was guaranteed renewable, so she was able to keep her coverage, but her premium increased to $350 a month. And her waiting period was extended from 60 to 90 days. Assuming her income remained the same between her two jobs, the increase in premium and waiting period on her disability policy was primarily due to the increase in risk from her new job from a 3A to an A class. Furthermore, without applying for a new disability insurance policy, the insured can request a reclassification if his risk decreases over time. For example, if he is a new salesperson, he will be in Class 2A. After 5 years in the same occupation demonstrating stability and increasing income, he could be reclassified to 3A without changing jobs. However, in order to qualify, medical and financial if he increases his benefit, underwriting will be necessary. 2.2.3.5 Waiver of Premium. For DI policies, waiver of premium is not a rider, as it is with life insurance policies, but is an intrinsic provision of the contract for which no additional premium is charged. The waiver provisions waive the policyholder's obligation to pay premiums during the time that the life insured under the policy is on disability claim. Typically, the premium must be paid by the policyholder during the first 90 days of claim, and then the waiver commences. Many policies will refund the premium paid during the 90-day waiting period. The premium will be waived for the duration of the disability claim, or for a period of anywhere from 2 to 5 years, to the end of the benefit period, or even to the life insured's age 65, whichever comes first. Depending on the terms of the contract, waiver of premium may apply only to claims involving total disability or to instances of partial disability as well. 2.2.4 Riders to address needs. Disability insurance policies vary from one insurer to another. Even though they have standard clauses and definitions, the insurer may adjust their pricing with specific riders or restrictions to reduce their risk and allow the client to access affordable coverage. 2.2.4.1 Concept of customization. Customizing means modifying the terms and conditions of a standard DI policy by adding riders to the contract, special clauses that add, remove, or restrict benefits in accordance with the needs of the applicant for protection or the wishes of the insurance company to limit its exposure to risk. A number of the more common riders are described in some detail below. 2.2.4.2 Differences between equivalent riders. In reviewing a policy or recommending the purchase of a new policy, it is important to carefully consider the exact details of definitions or riders. There are standard definitions within the industry, but that does not mean that each contract or each rider adheres strictly to the standard. One cannot simply assume that a given rider will offer standard benefits. The rider text must be carefully scrutinized, or competing riders compared, to ensure that the riders in question are, in fact, equivalent. 2.2.4.3 Future Purchase Option, FPO. The Future Purchase Option, FPO, also sometimes called the Guaranteed Insurability Benefit, GIB, or Guaranteed Insurability Option, GIO, on a disability insurance contract serves the same purpose as a GIB/GIO on a life insurance contract. It guarantees the insured the right to purchase additional coverage in the future, regardless of future changes in the life insured's health. Traditionally, options to increase coverage were offered every 2 years or so. Policies issued more recently offer the options on each policy anniversary. Assuming that the underlying policy was issued at standard premium rates, any new coverage subscribed for under the FPO would also be issued standard based on the life insured's attained age 14 at the time the option is exercised. Options are usually available up to the life insured's age 50 or 55, depending on the contract. There will always be a maximum limit to the amount of coverage that can be purchased under the FPO, both on how much coverage can be purchased per option and how much can be purchased overall. The per option limit is often based on 20% of the base coverage, to a maximum of $1,500 a month of new coverage. The overall limit is typically in the range of 2 to 5 times the initial amount of coverage under the base policy. New coverage acquired under the option will be based on the same occupational class as the original policy, provided the insured has not changed occupations. If the life insured is on disability claim at the time the option arises, the contract may permit the FPO to be exercised immediately, or the exercise may be delayed until the termination of the current claim. The key restriction to exercising the FPO is that the insured must qualify for the additional coverage financially. As noted earlier in this chapter, the amount of disability income replacement insurance for which an individual can qualify is restricted to about 60% of his pre-disability earned income. This same limit applies to the exercise of an FPO option, if the coverage currently in force is equal to 60% of earned income. No further coverage can be purchased, even though the right to purchase coverage without medical evidence is guaranteed. Two rules apply. If the insured's current income has not changed since policy issue or exercise of the last option, and the coverage currently in force equals 60% of current income, the current option may not be exercised. If the insured's current income is such that 60% is greater than the current coverage in force, the current option may be exercised, to a maximum of the current option or an amount that would bring the coverage up to 60% of current income, whichever is less. Example: Fritz was earning $60,000 a year, net as a freelance handyman 2 years ago when he applied for disability insurance. He qualified medically and financially and was issued a DIP policy with coverage of $3,000 a month. 60% times $60,000, divided by 12. His policy has an FPO rider which permits him to increase coverage, guaranteed, by 20% of his original coverage, or $600 a month, this year, if he can qualify financially. His income has increased by $6,000 to $66,000 a year. At his new income level, Fritz could qualify financially for $3,300 a month of disability coverage, 60% times $66,000, divided by 12. Since he already holds $3,000 a month of coverage, he could exercise the FPO to purchase an additional $300 a month of coverage, despite the fact that the option allows for up to $600 a month of coverage without medical underwriting. In order to exercise an FPO option, the insured must provide the insurer with proof of current income. Also, exercising the FPO would add additional coverage, resulting in a corresponding increase in premium. 2.2.4.4 Cost of Living Adjustment, COLA. One of the problems faced by insureds living off the benefits of a long-term disability, LTD, claim is that the cost of goods and services, cost of living, that the disability benefits are intended to provide for are constantly rising with inflation, while the disability benefit may be fixed. A cost of living adjustment, COLA, rider provides for an annual increase in the monthly benefits being paid under a disability income replacement contract, starting the second year that benefits are paid. The benefit is payable by one of two methods. 15. Simple, the benefit is indexed by a flat rate, 2.00 or 4%, for example, based on the initial benefit payable. Compound, after the first year of claim, the benefit is indexed to the rate of inflation, on a compound basis. 15 usually based on the inflation rate for the previous calendar year. The indexing is based on the Consumer Price Index, CPI. Example: Jennifer is entitled to $3,000 a month in benefits under a DIP policy indexed to the CPI and under which the COLA is compounded. The following table illustrates how her monthly benefit will increase yearly due to the application of the compounded COLA. There may be a maximum indexing rate for any 1 year, 5% perhaps, but many policies allow for a carry forward of unused indexing. For example, if the indexing rate for year 4 of claim is 1.5%, lower than the maximum allowed under the contract, that 1.5% can be carried forward to future years, to create more indexing room for years when the inflation rate exceeds the maximum annual indexing permitted under the contract. On the other hand, the maximum amount of indexing is capped at a predetermined limit, such that the annual benefit ultimately paid out under an indexed policy might not be able to exceed 2 or 3 times the initial, unindexed, annual benefit. Some DI policies offer an alternative to COLA, called an automatic coverage enhancement, or automatic benefit increase, which automatically increases the benefit by a small set amount, 2 or 3%, without underwriting, medical or financial, but with a corresponding increase in premium. The option is subject to review, and possibly later underwriting, on a periodic basis, such as every 5 years. The automatic enhancement is offered instead of, rather than in addition to, COLA. The benefit provides an indexed policy with increasing premiums that applies the increase in coverage after the policy is issued and does not wait for a claim to be made. It basically attempts to keep up with annual raises that most employees receive. 2.2.4.5 Accidental Death and Dismemberment, AD&D. The Accidental Death and Dismemberment, AD&D, rider provides additional benefits, over and above those benefits payable on account of income loss due to disability, should the life insured incur death or specified severe injuries due to an accident. For a claim to be receivable, the death or loss must occur within 365 days of the accident in question, and the death/loss must be directly attributable to the accident. Typically, a specified lump sum benefit, referred to as the principal sum, will be paid in the event of death, and lesser benefits, a percentage of the principal sum, would be payable for the loss of, or loss of use of, sight, hearing, or one or more limbs, etc. Because benefits are only payable in the event of accidental loss, no medical underwriting is required at time of issue of the rider. This is not to be confused with the survivor benefit, discussed later in this chapter, for which there are different criteria for filing a claim in the event of death. Standard exclusions apply, like loss or death due to self-inflicted wounds, attempted suicide, participation in dangerous sports, flying other than as a passenger on a commercial airliner. 2.2.4.6 Partial and residual disability benefits. If disability insurance were an all or nothing proposition where you got full benefits if you were totally disabled, but no benefits at all if you were to return to work part-time, it would be very difficult to encourage a disabled worker to return to work part-time. Residual disability benefits. As an incentive for disabled workers to return to work as soon as possible, many DI policies offer a residual disability benefit, one that will pay the disabled a portion of his benefits if he is able to work part-time following a period of total disability. In order to qualify for the benefit, the insured must first meet specified criteria, usually a minimum period of total disability under the contract, often 6 months, including the waiting period. If the disabled worker is then able to return to work and perform some of the substantial duties of his job, or all of the substantial duties but only for part of the time, he will have 2 sources of income, part of his employment income and part of his disability benefits. There are minimum and maximum income requirements for an insured to qualify for residual benefits. There must be at least a 20% reduction in his pre-disability income before he can qualify for benefits. Or, expressed another way, if he can earn 80% or more of his pre-disability income, he will not qualify for any benefits. On the other hand, if the insured can only earn 20% or less of his pre-disability income, he will qualify for full benefits. Earnings between 20% and 80% of pre-disability income will result in a pro rata benefit, proportional to the percentage of income lost to disability. Example: Jorge was earning $80,000 a year working as a graphic artist for a small company that offered no group benefits. To protect himself against income loss due to disability, Jorge took out an individual DIP policy that would pay him $3,000 a month, 45% of his income, in the event of total disability. Last year Jorge was injured in an auto accident and was off work for 10 months. Receiving disability benefits of $3,000 a month for 7 of them, after allowing for a 90-day waiting period. A doctor advises Jorge that he could now return to work 2 days a week, which would result in his earning the monthly equivalent of $32,000 a year, 40% times $80,000. George's policy has a standard residual disability clause. As a percentage, his loss of pre-disability income while working part-time is calculated as pre-disability income. Part-time income equals $80,000 to $32,000 equals 60%. Pre-disability income $80,000. While working part-time, Jorge would receive 60% of his maximum disability benefit, or $1,800 a month, $3,000 times 60%. Combined with the $2,667 a month that Jorge would earn in salary, $32,000 divided by 12, he would total $4,467, or $53,604 a year. Partial disability benefits. Some insurance contracts will pay a partial disability benefit from the outset of disability, not requiring a period of total disability. If the insured is unable to perform some of the substantial duties of his job, or is able to perform all of the substantial duties but only for part of the time, he would receive 50% of the total disability benefit for a period of 2 to 3 years, considered the partial disability benefit, or the residual disability benefit, whichever is greater. Some DIC contracts require a qualification period of total disability before partial disability benefits will be paid in all. Contracts require that the insured be under a physician's care. 2.2.4.7 Return of Premium, ROP. A common concern with disability insurance, as with most types of insurance, is that the policyholder may pay thousands, or tens of thousands, of dollars in premiums over time but, if no valid claim is ever filed, never receive any benefit for the premiums paid. The return of premium, ROP, rider addresses this concern. Typically, the rider provides for a tax-free return, refund, of premiums paid if the policy expires, at the life insured's age 65, for example, and the total claims paid over the life of the policy do not exceed the total premiums paid. For example, if there are no claims by age 65, when the coverage expires, 70% of all premiums paid are repaid to the policyholder. If claims are filed during the life of the policy but the total of benefits paid out is less than the total of premiums paid in, the difference would be paid to the policyholder when the coverage expires. If the total of benefits paid out over the life of the policy exceeds the total of premiums paid in, no return of premiums is payable. Some policies provide that if a policy is cancelled prior to its maturity date with no claims having been filed, a partial ROP is paid. Other policies provide that, if the contract goes for a specified period, typically 8 or 10 years, without a claim having been filed, anywhere from 4 times the annual premium to 70 to 80% of the premiums paid during that period or a proportion of the annual premium will be returned to the policyholder. The rider is expensive, however, often adding 40 to 60% to the cost of the base DIP premium. 2.2.4.8 Ratings and exclusion riders. If an applicant for disability insurance has health or lifestyle issues that result in his being assessed as a higher risk than standard, the underwriting department has 3 options for dealing with the application. Decline to issue the policy. Impose a premium rating. Add an exclusion rider to the policy. A decline is usually the option of last resort. It means that the policy is not issued. Premium rating can be used to assume risks that are substandard, but not so high a risk as to be uninsurable. This is particularly true where the applicant has an overall health issue, like diabetes or hypertension, which could impact the applicant's general health or ability to function. The increased premium, the premium rating, compensates the insurance company for the increased risk that it is willing to assume. If the condition in question is controlled with treatment in the future, the insured may have the option to be re-underwritten medically and have the rating lowered or removed once the condition is under control. In some cases, the circumstances that make the life to be insured a substandard risk might be a specific lifestyle or vocational activity or a specific condition that is more likely to trigger a period of disability. In such cases, the insurance company might issue the policy but with an exclusion rider that specifies that no benefits will be payable on account of a disability arising from the identified activity or condition. Example: Eldridge applied for disability income replacement insurance despite the fact that he had a damaged disc in his back, the consequence of his sporting activities. The insurance company was willing to issue the policy at standard premium rates, but with an exclusion rider that stipulated that no benefits would be payable on account of a disability related to Eldridge's back problems. In instances where an exclusion rider has been added to a DIP policy, it is typical for the contract to be issued with a standard premium, which saves the insured from paying a premium surcharge and allows coverage for episodes of disability resulting from any other standard cause not covered by the rider. 2.2.4.9 Hospitalization Benefit. Basic disability income protection insurance provides benefits to replace earned income lost during a period of disability but does not provide additional cash flow to cover extra expenses incurred as a consequence of that disability. For example, if the injury or illness that caused the disability results in the life insured having to spend time in the hospital, extra expenses may be incurred. Special riders may be added to a DIP policy to cover those expenses. One such rider is the first-day hospitalization rider. Hospitalization costs may arise long before any benefits become payable during the waiting period under the base policy. The first-day hospitalization rider is designed to bridge the gap between the first day of hospitalization and the first day that disability benefits begin, often 90 days later. The rider has no waiting period, but typically requires a minimum hospital stay of from 24 to 72 hours for benefits to be payable. The benefits involved are a daily prorata of the monthly disability benefit under the base policy. The hospital indemnity rider provides a daily benefit, usually between $50 and $250 a day, to cover specific expenses incurred as a consequence of hospitalization. It might, for example, cover child care expenses for a spouse visiting a hospitalized spouse on a regular basis over a prolonged period of hospitalization or parking costs at the hospital, which can be substantial, for that same visiting spouse. It is typically a first-day benefit, providing the hospitalized individual has a stay of at least 24 hours and may provide benefits for 3 or 4 months, maximum. 2.2.5 Taxation of Individual Disability Insurance, D. Benefits. Individual disability insurance benefits are generally tax-free and premiums are not tax-deductible. However, this is not always the case, for example for insurance policies taken out by companies. 2.2.5.1 Tax treatment of premiums and benefits. Generally speaking, premiums paid for individual disability income replacement policies are not deductible for income tax purposes and benefits received do not have to be included in taxable income. This is the case for disability benefits, treatments paid for by the insurer on behalf of the insured and waiver or return of premium, ROP, benefits. This remains true almost regardless of the purpose for which the policy was purchased. 4. Example, a key person DIP policy taken out on the life of an employee of a sole proprietorship falls into the category, so long as the employer pays the policy premiums and is beneficiary of the Contract. The policy premiums may be a valid business expense, but they are not a tax-deductible expense, and the benefits are tax-free. There are some exceptions to these rules, such as business overhead expense, BO, insurance, that are covered in detail in Chapter 5. Individual policies taken out by an employer on a class of employees on a grouped basis are subject to different tax rules, but, again, these are outlined in some detail in Chapter 5. If a policy is taken out by an incorporated employer on the life of an employee and the benefits are payable to the employee, then the premiums will likely be tax-deductible by the employer and the benefits will be taxable for the employee. In addition, either the premiums paid by the employer, or the benefits received by the employee, but not both, will be treated as taxable income in the hands of the employee. 2.2.5.2 Taxation differences between personally owned and corporately owned disability insurance policies. Many of the same rules apply to corporately owned policies as personally owned policies. Disability insurance purchased to protect the corporation's financial interests in the event of the long-term disability of a key employee, or to buy out the interest of a permanently disabled shareholder, is treated the same as a personally owned policy. The premiums paid are not tax-deductible, nor are benefits received by the corporation a taxable inclusion. If a corporately owned policy is ensuring an employee's ability to work and the employee is the beneficiary of any policy benefits, the premiums paid will be a deductible business expense for the employer but a taxable benefit for the employee for the year in which they are paid. On the other hand, if the life insured under a corporately owned policy is a shareholder of the company, or both an employee and a shareholder, the Canada Revenue Agency, CRA, is likely to rule the premiums paid to be a shareholder benefit, non-deductible by the employer but taxable in the hands of the shareholder. 2.2.6 Conversion of policy. Conversion is a provision most commonly associated with life insurance policies, the right to convert a term life insurance policy into a permanent life policy with the same insurer without having to provide medical proof of insurability, or to convert group life insurance to individual life insurance of the same nature. The group insurance coverages are also convertible to individual insurance coverages without proof of insurability. Furthermore, buy/sell insurance policies and BO insurance policies also contain a conversion clause. In instances where the coverage is no longer required for business purposes, the business has been disbanded, or the life insured is no longer an employee or co-owner of the business, the conversion privilege will permit the life insured to transfer the policy and coverage into his own name, without medical underwriting, such that the policy is now personally owned individual coverage. At the time of conversion, the insurance company may not re-underwrite the coverage financially, to redetermine if the insured can qualify for the face amount. That decision would have to be made at time of claim. As noted early in this chapter, many non-cancelable policies also offer the policyholder the option to convert the contract to a guaranteed renewable policy at age 65, with a limited duration and benefit period. 2.3 Group disability insurance. Group disability insurance is provided to many individuals under the umbrella of one master policy, with employer/employee group plans, which will be the primary focus of this section. The employer is the policyholder and the employee is the life insured and the beneficiary. Group plans offer coverage with little or no administrative effort on the part of the insured. For that reason, many people have primarily, or only, group coverage. 2.3.1 Providers of group disability insurance. Because group disability insurance, coverage is usually offered to the members of the group without medical underwriting, it is important to the issuing insurance company that the group members have some element of commonality, so that their risk can be pre-assessed based on criteria other than actuarial tables. For that reason, group insurance is not just offered to anyone who wishes to take advantage of it, but to potential lives insured who exhibit some Common traits such as work for the same employer, work in the same industry, are members of the same association, are alumni of the same university, belong to the same union, etc. The common factor offers the insurer at least two advantages: the opportunity to underwrite based on shared characteristics and risks, and a central organization of some sort to administer the plan, enroll members, collect premiums, etc. 2.3.1.1 Employer/employee groups are by far the most prevalent. Many employers, particularly large companies, find that it is essential to offer current and prospective employees competitive group coverage in order to attract and retain good employees. Many job seekers will not consider a prospective employer unless the employer offers an attractive employment package, including salary, vacation days, a pension plan and group insurance benefits. From the employee's perspective, obtaining insurance coverage from the employer's group is a simple, convenient and cost-effective way to build a base for their risk management program. 2.3.1.2 Association. Association groups are comprised of individuals who have characteristics in common but who do not work for the same employer. However, the association may consist of individuals who have employers in common. The association may be formed by several employers in the same industry, such as the automotive industry, or by franchise owners of the same franchise organization, such as a donut shop franchise. The plan members are the employees of these employers or franchise owners. The members are able to access the many advantages of participating in an employer/employee group, such as the cost efficiencies that come from volume discounts on coverage. A second type of association group brings together individuals who do not have employers in common. Often the members participate in the same profession, as in the case of the Canadian Bar Association Group Plan or the Canadian Medical Association Group Plan. Or the plan members have past associations in common, such as being alumni of the University of Toronto. For this type of association, membership in the group plan is solicited by the plan administrator and the potential members are free to join or not join as they wish. There is no requirement that a certain percentage of the group must participate in the plan. Benefits are similar to those offered by other group plans. The plan members are responsible for paying 100% of the insurance premium, usually by direct bank debit. 2.3.2 Types of Group Disability Insurance, D. Policies. Group disability coverage is usually divided into two distinct categories, each of which may have different definitions of disability, different benefit levels and different waiting and benefit periods. Short-term disability and long-term disability. Also, there is usually a different set of rules applicable to those group members who experience disability while on a leave of absence. 2.3.2.1 Short-term disability, STD. Short-term disability, STD, coverage is generally part of group insurance programs, but is not always offered. It is sometimes referred to as weekly indemnity and is designed to provide benefits for disabilities of short duration, usually less than 1 year. It also typically provides one level of benefit for the early stages of a long-term or a permanent disability, to be replaced after 1 year by the long-term coverage. STD benefits are based on a percentage of salary. Because plans are usually designed such that the employer pays 100% of the premiums for the STD coverage and benefits are taxable income, the percentage of salary is usually higher than that used for long-term disability benefits. STD benefits are likely to be in the range of 70 to 75% of pre-disability income. The definition of disability for short-term group insurance coverage is generally own occupation. There should be no misunderstanding of the definition of own occupation, disability and individual disability insurance discussed above. In order to understand the difference, it is important to understand that the definition of own occupation in group disability insurance has the same Characteristics as the definition of regular occupation in individual disability insurance. Thus, the definition of own occupation in group disability insurance refers to the inability of the insured to perform the duties of his regular occupation. Under the definition of disability, if the employee qualifies for a related job, he must choose between taking that job and claiming his group insurance benefit, but cannot have both. Benefits often start after a 7-day waiting period in the case of disabilities arising from illness and on the first day for disabilities arising from an accident. In either case, the maximum benefit is almost always 12 months. Example: Myron works for a company that offers its employees a group disability plan, which includes both STD and LTD coverage, providing for a combined 5-year benefit period, 12 months for STD and 48 months for LTD. Normally, Myron earns $4,000 a month when working. A couple of months ago, Myron injured himself when a golf cart that he was riding on during a weekend tournament tipped over and badly damaged his leg. Myron's job as a plant supervisor requires him to walk around the plant regularly to oversee the work of the employees, so his injury qualified him as disabled according to the group insurance definition of own occupation under his STD coverage. The plan provides for a benefit equal to 70% of salary, so Myron will receive taxable disability benefits of $2,800 a month, $4,000 times 70%, for up to 12 months or until he returns to work, whichever comes first. If Myron is still disabled after 12 months, his coverage will change from short-term disability to long-term disability. Some plans insuring lower-paid workers stagger their waiting and benefit periods to coordinate benefits with employment insurance, EI, benefits. EI has a maximum 15-week benefit period after a waiting period of 1 week, but EI is a second payer to many other forms of disability coverage, including group plans. Plans designed to coordinate with EI and avoid the dollar-for-dollar offset of EI benefits will pay a first-day benefit for 1 week, then no benefits for the next 15 weeks. Resuming benefits starting at the beginning of week 17, at the end of the EI benefit period. 2.3.2.2 Long-Term Disability, LTD. Long-term disability, LTD, coverage takes over when benefits under the short-term disability coverage expire with the plan member still being disabled. The waiting period for the LTD coverage is, in effect, the benefit period for the STD coverage. The amount of LTD monthly benefits is generally lower than that paid under STD, typically between 50 and 60% of previous income, compared to 70 to 75% for STD, and are generally payable for a period of 2 years, 5 years, or 10 years, or to age 65. Short-term disability benefits are mostly taxable while long-term disability benefits are tax-free. The benefits are usually based on an own occupation definition of disability for the first 12 months of LTD, changing to an any occupation definition thereafter. Example: Kant. After 12 months, Myron's leg still had not healed sufficiently for him to return to his regular occupation as a mobile supervisor. He will therefore continue collecting his disability benefits, but now under the long-term disability coverage from the group plan. His monthly benefit was reduced from 70% to 60% of salary, from $2,800 a month to $2,400 a month. The qualifying definition will change to regular occupation for the first 12 months of long-term disability. After that, this definition will change to an any occupation definition at the end of month 24, i.e., 12 months of short-term disability and the first 12 months of long-term disability. By that time, Myron will be expected to have taken on other suitable duties within the company, if possible, such as administrative tasks where he does not have to travel. Therefore, if a suitable alternative was available to him and he decided not To pursue it, his long-term disability benefits would automatically stop after 12 months. On the other hand, if he was unable to perform the proposed administrative duties, his benefits would continue for up to 3 more years, completing the 5-year benefit period that his group plan provides for a combined STD/LTD claim. 2.3.2.3 Disability during a leave of absence. There is a wide variance of coverage and restrictions that are applicable if a group plan member becomes disabled while on a leave of absence. 16 Leaves may be granted on compassionate grounds, to permit an employee to care for an ailing family member, for example. Or a leave may be granted to permit an employee to do independent research, or just to permit a break from work routine. In some jurisdictions, for example, teachers are permitted to work 4 for 5, work 4 years receiving 80% of salary and then take the 5th year as a leave of absence, sabbatical, still receiving 80% of regular salary during the leave. Various group DI plans handle disabilities during a leave of absence differently. Some offer no coverage during a leave. Others will provide coverage but only if the group premiums are still being paid monthly, either by the employer or directly by the employee. Often even under an employer pay-all plan, disability premiums coming due during a leave of absence will be the responsibility of the employee alone. Some plans do not pay benefits during an unpaid leave of absence since the plan member has no income to lose to the disability. There are no hard and fast general rules. 1. Must look to the details of the master contract to determine which benefits are, or are not, applicable. 2.3.3 Plan enrollment and membership. Member enrollment and maintenance of member records are the responsibility of the group administrator. However, the function goes beyond mere enrollment and claims administration, and involves record keeping and reporting to the insurer both before a new member qualifies for benefits and after the member leaves the group plan. 2.3.3.1 Qualification period. Most group DI plans require a new employee to undergo a qualification period before they can join the group plan. Not to be confused with the waiting period for disability benefits, the qualification period is a set number of days that must expire between the date of employment and the date that the employee qualifies to join the group plan. Often the qualification period is tied to the probationary period for employment, that period of 30 to 90 days when a new employee may be terminated without recourse. In part, the qualification period relieves both the employer and the group plan administrator from having to enroll and then terminate from the group plan an employee who does not stay with the employer beyond the probationary period. 2.3.3.2 Premium payment. In the case of non-participating 17 employer/employee group DI plans, the premium process is straightforward. The employer makes one payment to the insurance company each month, representing premiums on behalf of all of the group members. Premium payment for large participating group DI plans, where a portion of the premium is paid by the employees and is non-deductible for them, could be more complex. If the individual plan members were to pay their portion of the monthly premiums directly, the insurance company might have to deal with hundreds, or thousands, of individual payments. For this reason, most insurers insist that the employer collect the employee's portion of the premiums from each plan member monthly, via payroll deduction, and remit a single payment representing both the employer and the employee portions of the monthly group premium. In the case of association or union-sponsored group plans, each member usually pays his own premium monthly, via direct debit from his bank account. 2.3.3.3 Terminating membership. A plan member could find his participation in the group DI plan terminated for any one of a number of reasons. The master contract itself might be terminated, at the initiation of either the employer or the insurance company. The member might cease to be an employee of the sponsoring employer. The member might cease to meet the definition for membership in the class of the covered group. For example, his weekly employment hours might be reduced below the minimum requirement. For group plan membership, the employee/group plan member might retire. In circumstances where the plan member no longer qualifies for membership, he may have the option to convert his group coverage to an individual DI policy with the issuer of the master plan, without necessarily having to provide medical evidence of insurability. The conversion must then be made within 30 days of termination of participation in the group plan and is usually subject to some restrictions as to the type of policy to which the group coverage may be converted. 2.3.4 Amount of benefit. The amount of disability benefit available to group disability insurance, DI, plan members is subject to restriction on several different levels. A non-evidence maximum amount, without medical evidence, that is absolute, spelled out in the master contract, regardless of the plan member's qualifying income. A maximum overall amount based on a percentage of the group member's qualifying income, with medical evidence. An all-source maximum that is governed by group offset rules set out in the master contract. 2.3.4.1 Non-evidence maximum, without medical evidence. To ensure all group members can receive some benefit regardless of their health, most Group DI plans offer a basic amount of coverage for which medical underwriting is not required. This is the non-evidence maximum, without medical evidence, and it is set by considering the costs to the plan sponsor and the claim risk to the insurer. 2.3.4.2 Overall maximum with medical evidence. Recognizing that some plan members may wish to obtain a higher level of coverage, group plans may permit plan members to apply for additional coverage over and above the basic amount, which is the amount not requiring medical evidence. This additional coverage is restricted to the amount individual members can qualify for financially. It is also subject to medical underwriting, and the premiums are borne solely by the plan member. The overall maximum monthly benefit that a plan member may receive, with or without medical evidence, is spelled out in the master group plan. Larger groups typically offer larger maximum monthly benefits, often in the $10,000 to $15,000 range, while smaller groups may be restricted to a maximum benefit of $2,500 a month. A given plan member will have his coverage maximum determined by a percentage of his income or the group plan maximum, whichever is less. Example: Chang and Eng are members of the same employer group DI program, which provides for maximum long-term disability coverage of 60% of salary, or $5,000 a month, whichever is less. Chang, who earns $90,000 a year, qualifies for a maximum benefit of $4,500 a month, $90,000 times 60%, divided by 12. Eng, who earns $120,000 a year, is restricted to the maximum monthly benefit of $5,000, despite the fact that his income could qualify him for $6,000 monthly benefit, $120,000 times 60%, divided by 12. The percentage of earnings that will be considered in setting the overall maximum coverage will, in part, depend on whether benefits will be treated as taxable income or will be tax-free. STD benefits are typically in the higher percentage range, 70 to 75% of pre-disability income, allowing for the fact that STD benefits are normally taxable. LTD benefits, which are usually structured to be tax-free, are typically based on a lower percentage of salary, in the 60 to 66.66% range. As stated earlier, if members elect the maximum coverage available, the difference between the overall maximum and the non-evidence maximum amount of coverage is subject to both financial and medical underwriting. Example: Brandy works for a company that offers group DI coverage. The non-evidence maximum amount of LTD coverage is 50% of salary and the maximum benefit is set at 66.66% of salary, to a maximum of $10,000 a month. Brandy, who earns $90,000 a year, has elected to take full coverage of $60,000. 66.66% of $90,000, which represents $5,000 a month. The first $45,000 of annual coverage, 50% of salary, would be provided on a non-evidence basis. But Brandy would have to qualify medically to add the additional $15,000 of coverage, 16.66% of salary. The employer or the employee has the possibility of electing coverage that is less than the maximum set out in the master contract. 2.3.4.3 All-Source Maximum, also sometimes called Group Offset Amendment. The reason that DI plans, whether group or individual, set benefit maximums somewhere below 75% of the insured's regular income is to provide a disabled insured with an incentive to return to work. The same rationale applies when looking at the maximum benefits available from all disability income sources, the all-source maximum. The Group Offset Amendment found in virtually every group master contract specifies the maximum amount of coverage permitted from all sources. These benefit sources can be classified as being direct or indirect. Direct sources are disability plans that pay monetary benefits directly to the disabled plan member, such as the Canada Pension Plan, CPP, Employment Insurance, EI, or the Workers' Safety Boards. Indirect sources are benefits paid to or for the benefit of dependent spouses or children of the disabled life insured. Such benefits could come from sources such as the CPP. 18. Benefits arising from personally owned DI policies are usually exempt from the all-source maximum rules, but these plans may have their own offset rules set out in the contract. The offsets in group master contracts usually state that benefits from all specified sources cannot exceed 85% of the plan member's pre-disability income. If the total benefits available exceed this level, then the group benefits paid will be reduced offset to bring the overall benefits paid back down to the 85% maximum. Example: Mr. Lee earns $60,000 a year as a plumber. He is employed with a company that provides an LTD benefit equal to 66.67% of its employees' regular pre-disability income, or $3,333 a month. $60,000 times 66.67%, divided by 12. In the event of disability, Mr. Lee could also qualify for benefits of $1,020 a month from a personal policy, for a total of $4,353 a month of benefits. This would represent benefits of $52,236 a year, or 87.1% of his regular income. The 87.1% exceeds the 85% all-source maximum specified in the group plans master contract, so Mr. Lee's monthly benefit from the group plan would be offset by $103 a month, $4,353, 85% times $60,000 divided by 12, to an amount of $3,230, bringing the total monthly benefit from all sources to $4,250, or 85% of his pre-disability income level. 2.3.4.4 Denial of benefits. Benefits from group DI plans can be denied for the same reasons as benefits from individual plans addressed earlier. In addition, benefits from group plans would not be paid if the member had ceased to be a member of the group. 2.3.5 Taxation of group disability insurance benefits. In the case of employer/employee group DI plans, STD coverage is usually fully paid for by the employer and benefits received by the employee are treated as taxable income. That is why short-term benefits are typically a larger percentage of pre-disability income, often in the 70 to 75% range. Premiums paid by the employer for the STD coverage are a deductible business expense for the employer. In the case of LTD coverage, which often pays about 60% of pre-disability income, if the premiums are paid by the employer, the benefits received by the employee will be taxable income. As with STD, the employer-paid premiums are a deductible expense for the employer. However, if the Employee/plan member pays 100% of the premium, it is non-deductible for the employee and the benefits are tax-free. The plan is taxed in the same way as a personally owned DI policy. For this reason, most LTD coverage found in contributory group insurance plans is structured such that the employee pays 100% of the premium for the LTD coverage. In circumstances where both the employer and the employee contribute to the premiums for LTD coverage, an anomaly occurs. The employee's benefits, if any, are assumed to be a tax-free refund of premium up to the amount of aggregate premium paid by the employee since his last claim. Any benefits received in excess of that amount are treated as a taxable benefit in the hands of the employee. Example: Maddie is a member of a group DI plan where the employer and the employee share the premium cost for all group benefits on a 50/50th basis. Up until now, Maddie has never made a claim against the LTD benefits available under the plan. However, this year he was injured and ended up receiving a total of $17,000 in group LTD benefits. To date, Maddie and his employer had shared the $8,200 in total premium paid on his behalf for the LTD coverage. For tax purposes, $4,100 of Maddie's benefits, his 50% of the $8,200 of total premiums paid, would be a tax-free refund of premium, and the other $12,900, $17,000, $4,100, would be treated as taxable income. 2.3.6 Integrating a group policy with an individual policy. Clients may rely on either group insurance or individual insurance to meet their financial protection needs in the event of disability, or may employ both options, using an individual policy to fill any potential gaps or shortfalls in their group program. The following is a brief discussion of two ways the types of plan can be integrated to meet all of the client's disability protection needs. Benefit amount. Group disability insurance, DI, plans will usually restrict coverage to a maximum of no more than 60 to 66.66% of income in the case of LTD and 70 to 75% of income for STD. Plan members who might wish a higher level of benefit could supplement their group coverage by purchasing an individual DI plan with the same weighting and benefit periods as the group plan, but with benefits that would fill the gap. Example: Andre's group policy offers LTD coverage of 60% of his $80,000 annual salary, or $4,000 a month of benefits, $80,000 times 60% divided by 12. He would be more comfortable with a 75% benefit level, or $5,000 a month. $80,000 times 75% divided by 12. He could supplement his group coverage by taking out an individual DI policy paying $1,000 a month of disability benefit, but otherwise on the same basis as the group plan. Care must be taken to ensure that the total amount of coverage in place between the two plans does not exceed the 85% all-source maximum laid out in either, or both, contracts. Otherwise, offsets might void some of the advantage of the extra coverage, leaving the client paying for coverage from which he could never benefit. Claims are filed against the group policy first, as first payer, and then against the personally owned plan, if there is an overlap in coverage. Therefore, it is the group disability policy that will be reduced, not the individual disability policy. Benefit period. A plan member might also want a disability benefit that extends beyond the coverage provided by the group plan. This can be done by purchasing an individual plan with the same level of benefits and definition of disability as the group policy, but with a benefit period that begins when the group insurance benefit period ends, provided it does not go beyond the insured's age 65th birthday. The waiting period of the individual policy would be tied to the benefit period under the group coverage. Example: Jacinta works for a company that offers group DI coverage based on 66.66% of salary, with a 60-day waiting period, but a benefit period of only 12 months. Each for STD and LTD and 12 additional months for disability insurance. She would much prefer a 5-year benefit period. She could supplement her group coverage by taking out an individual DI policy paying a 66.66% benefit. For 3 years, with a waiting period of 26 months, the combined waiting and benefit periods under the group plan, thereby extending her overall benefit period to 5 years, without going beyond 65 years of age. 2.4 Creditor disability insurance, and other providers. There is another classification of a group association not yet examined, creditors of the same financial institution. Lenders, banks, credit unions, and other lending institutions, via mortgages, personal or secured lines of credit and credit cards, will often partner with a life insurance company to offer disability insurance, DI, coverage, to ensure that regularly scheduled payments on the debt are made even during a period when the debtor is disabled and unable to earn an income. Creditor disability insurance is offered as a package deal with the loan itself, on an optional basis. Depending on the size of the debt being insured, the coverage may be offered with little or no medical underwriting at time of application, although the insured may be underwritten at time of claim, retroactively. There will invariably be a waiting period, often 60 days, and the policy premiums are blended in with the monthly loan payment and debited to the same account that provides the loan payment. The definition of disability qualifying the insured for benefits is invariably total disability, the inability to earn income due to illness or injury. A partial or residual disability would not qualify, for example. 2.4.1 Amount of benefit. The benefits available under group creditor disability insurance for a loan are tied to the monthly loan payment, including principal and interest. For example, the benefits may take the form of a monthly repayment percentage equal to 3% of the outstanding principal amount, up to a maximum monthly benefit in a maximum repayment limit. Example: a bank offers mortgage disability insurance that will pay a maximum benefit equal to the monthly principal and interest payments on the mortgage, to a maximum of $3,000 a month for 24 months. It also offers credit card coverage with a maximum benefit of the lesser of 3% of the balance and $600 a month, capped at an overall limit of $20,000. 2.4.2 Taxation of creditor disability insurance benefits. The tax treatment of group creditor DI premiums is simple and straightforward, mimicking the treatment of individual disability insurance. Premiums paid are a personal, non-deductible expense, unless the purpose of the loan in question was to earn income from business or property, i.e., a business or investment loan. Benefits are received, paid to the creditor on behalf of the debtor, tax-free. 2.5 How they compare. There are similarities, differences, strengths, and weaknesses to the three common sources of disability protection: individual, group and creditor insurance. Table 2.3 briefly summarizes, compares and contrasts these characteristics. Chapter 3. Insurance to protect assets. Competency component. Analyze the available products that meet the client's needs. Competency subcomponents. Analyze the types of contracts that meet the client's needs. Analyze the riders that meet the client's needs. 3. Insurance to protect assets. Life insurance policies provide cash to protect the financial interests of dependents and beneficiaries in the event of the death of the individual whose life is insured. Disability income. Replacement policies protect the financial interests of a life insured should he become disabled and unable to work and earn any income, due to injury or illness. Yet neither life insurance or disability insurance protect an insured's assets, investments, RRSPs, real estate, etc., and future estate value with a tax-free benefit to assist him for the payment of any health-related expenses if he suffers a catastrophic illness or condition and survives, perhaps for years or decades. The insured could possibly even return to work, albeit with altered health circumstances. Critical illness, CI. Also known as dread disease, insurance and long-term care, LTC, insurance provides such living benefits and help protect assets from erosion due to prolonged health-related expenses. Critical illness policies are designed to provide a tax-free sum of money to assist an insured in adapting to his changed circumstances caused by a life-threatening illness. And long-term care policies provide tax-free funds for care services for those insured persons who can no longer care for themselves independently, due to illness, injury, or the effects of aging. 3.1 Critical illness, CI, or dread disease, insurance. Individuals that suffer such catastrophic health events as a life-threatening cancer, heart attack, or stroke may, or may not, eventually be able to return to work full-time, but they will almost certainly incur expenses or changes in their lifestyle that are not covered by conventional disability insurance. These individuals might require funds to permit them to make substantial lifestyle changes to accommodate the changes brought about by their medical condition. There are no particular restrictions on how the benefit can be used. Paying off debt, such as mortgages or credit card balances, to ease the financial stress arising from a prolonged recovery period, increased medical expenses and/or a reduced future earning capacity. Alternative treatments to those covered by provincial medical plans. Home renovations required to accommodate changes in the individual's physical capacity, for example, widened doorways and ramps to accommodate a wheelchair. Choice to work part-time, due to reduced physical capacity or simply a desire to spend less time at work to engage in other activities, a common psychological response to a brush with a life-threatening condition. Conventional medical expenses not covered by provincial health plans. Vacations to help lower medical stress. Changes of employment to a job with lower stress or physical requirements, with an attendant decline in earning capacity, etc. Without CI insurance benefits, these lifestyle changes could have a significant negative impact on one's assets. With improvements in emergency medical treatment, and medical care in general, the pool of individuals who suffer a life-threatening condition in life is expanding. Consider the following. Canadian statistics for the four most prevalent critical illness conditions alone: 19. 1 out of every 2 heart attack victims is under the age of 65 and 95% survive their first attack. 1 out of 3 Canadians will develop some form of cancer and 65% of them will survive for at least 5 years. 1 out of 20 Canadians will suffer a stroke before age 70 and 75% of those will survive it. Between 3 and 5% of critical illness claims are made by people who had coronary bypass surgery. CI insurance is designed to provide financial support for people affected by critical illnesses. 3.1.1 Coverage provided. Introduced in Canada in the mid-1990s as a standalone contract, CI insurance offers insured individuals a lump sum payout to be used at the discretion of the insured should he suffer any one of a broad range of life-threatening or life-altering conditions. 3.1.1.1 Minimum/maximum issue ages. For adults, policies will usually be issued for qualifying applicants between the ages of 18 and 65. After which the risk of claim becomes too high for most insurers to wish to assume. There are also special, more limited, children's plans available offering much lower benefits than the adult plans. 3.1.1.2 Minimum/maximum face amount. Policy minimum and maximum face amounts vary by insurer, with some issuing contracts for as little as $10,000 and others willing to go as high as $2 million. The more typical face amounts are in the range of $50,000 to $500,000. The actual amount of coverage issued to a given applicant will depend on a number of factors, including age, financial status relative to the amount of insurance applied for, to avoid overinsurance, current health status, applicant's medical history, Applicant's parents and siblings' medical history. 3.1.1.3 Qualification period. It is standard for a critical illness policy to have an exclusionary clause that specifies that an otherwise covered condition that is first diagnosed or which first manifests itself within 30 days of policy issue will not be covered. This 30-day period is called the qualification period. Some insurers may require an exclusionary period between the issue date of the policy and the onset or diagnosis of a condition listed in the policy, before that condition would be covered for purpose of a claim. For example, in the case of cancer, the exclusionary period may be as much as 90 days. This period may vary in time or application from carrier to carrier. The purpose of the exclusionary period is to protect the insurer against anti-selection, applicants seeking coverage because they fear that they may have a covered condition. 3.1.1.4 Survival, waiting, period. Since critical illness insurance is designed to provide benefits to insureds who survive a covered condition, there is also waiting period between the date that a covered condition is diagnosed and benefit becomes payable, such that the insurer can have a reasonable expectation the insured will, in fact, survive the condition. The waiting period is often 30 days after the date of diagnosis, but may be longer in relation to certain conditions. 3.1.1.5 Duration of coverage. CI insurance policies are issued both as term and permanent contracts. Term policies run for a specific number of years, typically for 10 or 20 years, or to age 65 or 75. Permanent plans run from date of issue to the life insured's age 100, much like term 100 life insurance. The 10 and 20-year term contracts are often guaranteed renewable, but with an increase in premium on each renewal, to age 75. The additional premium is designed to partly offset adverse selection created by the guaranteed renewable without evidence of good health. These plans are also convertible to permanent coverage, up until age 65. Conversion may be effected without medical evidence, but the insured may not be on claim at the time they request a conversion. Most policies will expire after the payment of a claim, regardless of the claimant's age. However, as critical illness insurance is a relatively new product, coverage offered will undoubtedly evolve in the years to come. 3.1.2 Types of policies. One of the main ways by which critical illness policies are distinguished from each other is in the number of conditions that are covered. Many basic policies cover 3 or 4 conditions, 3-condition contracts cover heart attack, stroke and cancer, and 4-condition contracts also cover coronary bypass surgery. Many policies extend that coverage to 10 conditions, outlined below under conditions covered. Comprehensive policies will cover 20 or more conditions, also outlined below. Children's policies, under age 18, typically cover most, or all, of the conditions insured by comprehensive plans, but also a variety of conditions that are more closely associated with minors, like muscular dystrophy, type 1 diabetes, cerebral palsy, cystic fibrosis. Many of these plans are convertible to an adult plan once the child reaches a set age, such as 18 or 25. Some critical illness policies are offered through financial institutions which also issue mortgages. These plans are issued with minimal underwriting and are designed specifically to discharge the outstanding mortgage balance in the event that the individual applying for the mortgage should suffer a critical illness while the mortgage remains outstanding. Benefits are paid directly to the financial institution, subject to underwriting of the insured risk at time of claim. Some stand-alone mortgage, life and disability insurance policies also contain a clause for the payout of a benefit in the event that the insured should suffer a critical illness. Guaranteed issue contracts are issued by some insurers. All that is required is a brief declaration of good health at time of application. Understandably, such coverage will often be more expensive than a similar coverage that is medically underwritten, and the benefits are limited, typically restricted to less than $100,000. Some life insurance policies also offer an optional critical illness benefit, i.e., a basic rider, 3 or 4 illnesses and conditions covered, that can be added to the policy, for a reasonable premium. 3.1.3 Conditions covered. Not all critical illness policies cover the same illnesses or conditions, and there are some illnesses or conditions that are not covered by most policies, such as AIDS. In addition, the precise definition of a covered condition may vary from plan to plan. For example, the type of cancer or the degree to which it has progressed as a qualifying condition will vary from one insurer to another. Or, the degree of heart muscle damage may determine whether a heart attack is severe enough to warrant benefits under the definition included in a given contract. 3.1.3.1 Big Four: heart attack, stroke, cancer, and coronary bypass surgery. Most critical illness policies at least provide benefits for a qualifying life-threatening occurrence of the Big Four conditions: heart attack, stroke, cancer, coronary bypass surgery. 3.1.3.2 Expanded coverage. In addition to the Big Four covered conditions, insurers offer more far-reaching policies that may provide benefits to those lives insured who contract some of the following conditions. The list of conditions that may be offered as a rider to the basic plan and their number may vary from one carrier to the next. The following example is an indication of the type of coverage that may be offered. Of course, the more conditions that a policy covers, and the easier it is to meet the definitions of those conditions, the more at risk the insurer is of having to pay a claim, so the higher the policy premiums will be. The exact definition of these conditions may vary from policy to policy, although most conditions must be severe enough to be life-threatening before benefits would be payable. 3.1.4 Riders available. The two most common riders available under critical illness policies are the return, refund, of premium rider and the waiver of premium rider. 3.1.4.1 Return of premium, ROP. As an optional benefit, rider, many insurance companies offer their critical illness policy holders the opportunity to add a return, refund, of premium clause to their contracts that would pay back some, or all, of premiums previously paid by the policy holder should the insured die or the policy expire with no claim ever having been filed. The following types of returns can be offered. On death, premiums would be refunded to the estate of the policy holder, or to a named beneficiary. In whole or in part, should the insured die from a cause not covered as a critical illness under the policy, or should he die due to a critical illness but before the end of the qualification and waiting periods. On surrender, premiums would be refunded to the policy holder, in whole or in part, should the policy holder surrender, cancel, the policy after a prescribed number of years, 10, for example, with no claim having ever been filed. On maturity, premiums would be refunded to the policy holder in whole or in part, should the policy mature. Expire at age 75, for example, with no claim having ever been filed. 3.1.4.2 Waiver of premium. A waiver of premium rider may be added to a critical illness policy provided the insured qualifies medically and pays an additional premium. The rider waives all premiums ordinarily payable under the policy in the event of, and for the duration of, a period of total disability of the insured, or the policyholder, if the insured is not the one paying the premiums. The rider is added at the time of policy issue and is usually only available if the insured is age 55 or younger at the time of application. The waiver is usually subject to a waiting period of between 4 and 6 months from the onset of the qualifying disability, and premiums paid by the policyholder may be refunded once the waiting period has expired. Waiver will continue until the earlier of the recovery of the insured from the disabling condition. A successful claim for benefits for a critical illness. The expiry date of the policy. The conditions, disability, that would result in a waiving of premiums under the policy are different from those that would result in a successful claim for critical illness benefits. For example, an insured could suffer a minor stroke that is temporarily debilitating and triggers the waiver provision, but is neither severe nor permanent enough in the damage caused to trigger the critical illness benefit. 3.1.5 Payment of benefits. The payment of benefits under a critical illness contract is subject to a number of restrictions. The diagnosis or first manifestation of the condition, or disease, must occur more than 30 days after the issue date of the policy, the qualification period. The life insured must survive the diagnoses of the covered condition for at least 30 days, the waiting period, which may be extended to 90 days in some instances, such as a diagnosis of cancer or in the event of a stroke. However, benefits would still be payable to the estate of the insured or another named beneficiary should the insured survive the waiting period but die prior to approval or payment of the claim. The life insured must usually make a claim within 30 days of diagnosis of the qualifying condition. The claimant must provide medical proof of the qualifying condition within 90 days of filing a claim, and the insurance company's medical advisors must concur that the condition in question meets the requirements of the policy. Benefits are normally payable in a lump sum, but the policy may provide that the claim be paid in installments. There is usually only a one-time payout of benefits under a critical illness policy, similar to the situation with a life insurance policy. After a successful claim, the policy is cancelled. Example: Sylvia successfully claimed a $100,000 benefit under her CI insurance policy in 2011, due to diagnosis of a qualifying cancer. When she subsequently had a heart attack in 2013, she was unable to make a second claim under her policy, because the contract had been terminated upon payout of the 2011 cancer claim. Some policies, however, offer an optional second event rider, whereby coverage remains in force after a successful claim, and a lesser level of benefits may be paid in the event of a future unrelated claim. For example, if the first claim was related to a heart attack, a subsequent claim related to life-threatening cancer might give rise to the payment of a second, lesser benefit. CI insurance products may also contain other features, depending on the contract and the insurer. The Critical Illness Insurance Supervisory Report 20 mentions coverage for certain specific non-life-threatening surgeries or conditions. A partial benefit. For example, you purchase a $100,000 critical illness insurance policy that offers you 35% of the insurance amount for loss of speech. 2 years later, you do lose your speech. You will receive $35,000, 35% of $100,000. Recovery assistance, example monthly care benefit. Return of premiums, example on the date specified in the contract to exercise the return of premium option, or when no claims were filed with the insurers during the coverage period, upon death or maturity of the contract. Conversion of the contract, example to a long-term care contract at a specified age. 65, for example. Option to renew the contract, example for term insurance. The payment of benefits is subject to the standard exclusions. No benefits will be paid arising from act of war, declared or otherwise. Act of terrorism. Attempted suicide. Self-inflicted injuries. Normal pregnancy. Criminal activities. Abuse of non-prescription drugs. Non-occupational AIDS/HIV. 3.1.5.1 Tax treatment of critical illness premiums, benefits, and return of premium benefit. Similar to the circumstances with individual disability income replacement policies, premiums paid for individual critical illness coverage are not deductible for income tax purposes. Neither do premiums paid qualify for the medical expense tax credit. On the other hand, benefits received as the result of a claim or a refund of premium are not taxable income in the hands of the recipient policyholder. 3.2 Long-term care. The phrase long-term care often evokes the image of the aged ailing in a nursing care facility. Although that can be part of the scenario, long-term care is so much more. Those in need of Long-term care are individuals of any age who can no longer look after their daily physical needs independently. They could be young people suffering from a debilitating condition like muscular dystrophy or multiple sclerosis, those of any age who have suffered an injury, brain or spinal injuries, for example, that have left them severely physically or mentally restricted, or those suffering from the diseases of age, Alzheimer's or dementia. Long-term care itself can range from home care, provided in the patient's own residence, to assisted living facilities and nursing homes, depending on the needs of the patient. The balance of this chapter will examine the extent of the need for long-term care, the types of care available and insurance coverage available to help pay for the costs of long-term care. 3.2.1 Canadian demographics. Despite the diversity in long-term care patient situations, the need for long-term care remains primarily restricted to those over age 65. And, as the baby boomers age, the percentage of the Canadian population over age 65 is going to balloon over the next 20 to 30 years. Diagram 3.1 illustrates population trends by age and gender between 1961 and 2061. In the last 50 years, the age and sex structure of Canada's population has changed considerably. In 1961, toward the end of the baby boom, Canada's population pyramid had a wide base because of the large number of young people, reflecting the large cohorts born during this period. More than 50 years later, the bulge has moved up the pyramid as baby boomers, aged 46 to 65, in 2011, have grown older. The drop in fertility is apparent in the pyramid with a slightly narrower base. As the baby boom cohorts grow older and Canada's population continues to age, the structure of the population can be expected to increasingly resemble a rectangle, as shown by the pyramid for 2061 based on the medium growth scenario of the most recent population projections. The proportion of seniors has been steadily increasing for the past 50 years due to below replacement fertility and the lengthening of life expectancy. This increase will accelerate in the coming years as more baby boomers reach 65 years of age. According to the medium growth scenario of the most recent population projections, the proportion of seniors could start to exceed the proportion of children in 2017, with a subsequent widening of the gap. The proportion of the population that is of working age, 15 to 64 years of age, has remained at around 68% since the 1980s due to the presence of the baby boomers in this age group. In the next 50 years, as baby boomers exit this age group, this proportion could drop down to the levels recorded in the late 1950s and throughout the 1960s, that is, to approximately 60% of the population. 22 With so many likely to need long-term care assistance and relatively so few entering the workforce to earn and pay taxes to support them, where will future funding for long-term care come from? Individual long-term care insurance, LTC, coverage could be part of the solution to the problem. 3.2.2 Long-term care options. Long-term care isn't just about a stay in a nursing home. The healthcare community offers a wide range of public and private services, each progressively more comprehensive. The most common private/public services available are home care, respite care, assisted living, nursing home, facility, care. 3.2.2.1 Home care. The first tier of long-term care services involves health care in the home of the afflicted individual. This is usually the first choice for many seniors. If at all possible, they would prefer to receive services that could keep them at home for as long as practical. Even those suffering from cognitive disorders, like Alzheimer's, often take comfort from remaining in a familiar environment. Home care can improve seniors' quality of life, while still allowing them to retain their self-esteem and a feeling of security. Home care is most often provided where there is an informal caregiver family member in attendance and the patient's need is relatively minimal and likely to be only temporary. However, it can also be provided by professional healthcare workers or community service workers. Home care services are typically charged by the hour and may not be required on a daily basis. For example, nursing care, companionship services, home help services, such as Meals on Wheels and housekeeping/cleaning services. Personal care services, with the activities of daily living addressed in a later section. Overnight stay. 3.2.2.2 Respite care. In circumstances where the primary caregiver is a member of the patient's family, spouse, child, grandchild, etc., in a home care situation, the need to provide care 24/7, as in the case of an Alzheimer's sufferer, can become very wearing on the caregiver, both physically and emotionally. So that the caregiver's health, both physical and mental, does not suffer unduly, provision needs to be made to provide relief, respite, for at least a short period, from time to time. Relief might come from a few hours of assistance by friends or other family members, from community services or from a paid, formal care facility like a nursing home. Of course, such relief may come with a monetary cost, an overnight stay, or longer, at a nursing care facility, adult day care, transportation costs, etc. Example: Rudy, age 62, a retired accountant, looks after his 86-year-old mother, who has Parkinson's disease, on an essentially full-time basis. She lives with Rudy, and he has to assist her with many day-to-day activities and keep a watchful eye on her to prevent her from accidentally injuring herself. Although Rudy has nurses and care workers coming to his home to offer his mother regular therapy and assistance, the situation is still very wearing on him. Respite care would provide for Rudy's mother to spend a few days each quarter in a temporary stay at a nursing home facility, to give Rudy a much-needed break from the stresses of the day-to-day care routine. 3.2.2.3 Assisted living. The next step up from home care is an assisted living facility. These are usually transitional residences which offer support services to individuals